Vice Chair Chandra?
Here.
Trustee Abbott?
Here.
Trustee Chi?
Here.
Trustee Faulkner?
Here.
Trustee Linder?
Here.
Trustee Nakagawa?
Here.
And the chair is here. We have a time certain item today at 10 a.m., which is a disability hearing. And so we will take that at 10, and we will try to have a short break prior to that. Other than that, there's no need to waive sunshine. We will then go to the consent calendar. I would like to briefly pull from the consent calendar the review of the item 26B, the PAFR, and just have a brief discussion on that. Other than that, can we have a motion to accept the consent calendar?
I actually have another thing.
Okay.
I looked at the application for change of status to a service-connected disability.
Mm-hmm.
And it's about Andrade, but the bottom says it's in the hearing on the application by Eunice Wilson for the change of status to a service-connected disability. The footnote looks wrong on this.
This is on the agenda?
Yeah, it's on the consent calendar. The first,
Right, item 21A.
Yeah.
So I'm not quite, so what are you calling my attention to here?
So if you open this up and it says this is a hearing for the application by Veronica Andrade, but the bottom says in the hearing on the application by Eunice Wilson. So it feels like it's
Okay.
legally incorrect. I just opened it up just to see
Yeah.
what this is about, because I thought we talked about it, but.
I don't see it. I'm not following.
I'm looking at my paper agenda here, and I'm not
So
seeing
so
what you're looking at.
So if I click
I've
on-
opened up the attachment.
I see.
She's in the attachment.
I'm in the attachment.
Okay.
I don't have it.
I'm sorry, which attachment?
This is 21A for Andrade board materials.
Oh, I see. There,
And I have Andrade.
And it says Andrade at the top, and the bottom of the footnote, when you open it up, says in the hearing on the application by Eunice Wilson.
I see what you're saying.
Good. See what you're saying.
Mine wasn't here, so let's go back. It's not under two. Oh, yes.
what I would recommend is we pull this from the consent agenda. Sandra and Russ are not here yet. They'll be here
Okay.
for the hearing at 10 o'clock. If you
Yeah.
give us just a few minutes to circle back, because I'm not 100% sure where you're seeing that, but we can take a break and.
So let me just show
Okay.
you quickly. This says Andrade and this says Eunice Wilson. So I think that this is not,
We should.
it's inconsistent.
Yeah, I see what you're saying. We may have to, let me circle back with staff and if we have to pull it from the agenda so that we can update that, because it looks like maybe a cut and paste error at the bottom.
That's what it
Yeah,
looks like
no,
to me
you're
too.
100% right. I see what you're
Okay.
saying.
So can we still approve it on
Yeah,
the
let-
consent calendar? And
No,
just
I think she's suggesting we pull it for now
pull
and
it for
then
now.
revisit it. What do you guys think?
I would recommend you don't approve it as part of consent.
Okay.
Let me circle back with Sandra, and then
Yeah.
after our 10 o'clock time certain, I'll give some recommendation on how to move forward.
So we have proposals to pull from the consent calendar item 21A and item 26B. With those caveats, do I have a motion to approve the consent calendar?
So moved, Mr. Chair.
I heard in my right ear first, so that's a motion by trustee Linder, second by trustee Abbott. We're all present, so we can vote. All in favor?
Aye.
Okay, none opposed. Consent calendar is approved. At this time, I normally take public comment on any item that is, I'm sorry, not on any item, on items that are not on the agenda, but which are under the purview of this board. Is there someone who wishes to speak? There is a speaker. In this section of comment, we permit speakers to speak for 3 minutes. So if the speaker can announce themselves. They have 3 minutes. Please proceed.
Are you referring to me, Mr. Chair?
You're the first one up, yes.
Oh, okay. Well, hopefully there's more people than me.
There
But
may be.
anyway, thank you, Mr. Chair, and season's greetings to the trustees and the staff. And hope everyone's doing well. Hope you stay healthy. And here's hoping for a more productive 2026. And I just wanted again to share my invitation to all the board members to meet with their constituents, specifically myself. There had been at least, well, there was 2 board members that actually took me on that invitation, and I appreciated that. So would like to also meet the other board members if you would so do so. And first of all, well, I should have said that I wanted to give a big welcome to our new employee representative trustee, Mr. Chi. So I really welcome that, and hopefully we'll get some more diverse input. We won't have a lot of more groupthink, and really looking forward to Mr. Chi's participation on the board. And, again, I want to wish everyone a Merry Christmas and a Happy New Year. And again, hopefully we'll have better investment returns in 2026 and improve our funding status. Thank you, Mr. Chair.
Okay, thank you. Are there any other public commenters? No other comment? So, thank you. Before we proceed with the rest of the agenda, if I may take a point of privilege and also say welcome to our new trustee, Trustee Chi. And if he wishes, I'll give him a moment or two to introduce himself to your fellow trustees.
Sure. Thank you. Thank you for the welcome, Chair Horowitz, and also for the rest of the board, and also our previous speaker, Mr. Imamura. I really would like to give a little bit about my background. I'm currently the investment officer for the City of San Jose, working in the finance department, managing the city's treasury, approving wires, investing our excess funds. I would like to say that I look forward to getting a sense of how this board works, and also to doing the work of our board for our beneficiaries. And I would like to thank the employees for electing me with 90% of the vote. It's a strong vote of confidence from them. And I hope I can make the right choices for all of our beneficiaries.
Thank you so much. I'm sure you will be a valued and helpful voice on the board.
Thank you.
So we've never pulled anything from the consent calendar before, so do we deal with that now, or?
You do the consent, and then you can deal with the item.
Okay, so the first item was 21A, which appears to be, I guess, a typo issue on that particular disability application. Is that your understanding at this point?
It is. If we could schedule that to be with the, after the time certain.
After the time certain, okay, thank
We
you.
can go over those items in new business.
In new business, okay,
Okay.
okay. Okay, and then the one I pulled was the PAFR, and again, I guess we can discuss that new business. I'm just wondering, this has not been officially published yet, that's why it's on the consent calendar. And there's always this race condition where we don't know the funded status for the PAFR by the time the PAFR is published. But this year we do, and I'm wondering if we can include that in the chart that exists on, I don't know what page it is, but there is one that shows the progress of the funded status. So we do actually have data up to 2025. So I don't know if it's possible to include that before publication.
I'd have to check with finance on timing. I mean, I think technically it's not approved yet. It's on the agenda for today of 6D for final approval for the valuation, which would include the funding status. So you're right, it is a chicken and egg problem. I mean, we do post it. We do post them separately. They're both two separate items, but if I'd have to check with Benji to see if there's any timing issue as
Okay.
far as posting
Okay.
or keeping them consistent.
This is Benji.
Oh, hi Benji, thank you.
Yeah, if you would like to include that, we can. It just won't be consistent with police and fire because they haven't gotten theirs yet. But if that's, I mean, this is a separate, item anyway, so if you would like, we can do that
Okay.
before we publish.
Okay, well, I would encourage us to do that. I don't know, do we need a vote then to affect that, or?
I have another question.
Okay,
Would there be wording that needs to be changed if we change the chart?
my understanding would be no, because there's simply a chart that shows the progression on page 3, and so it's showing years 2015 through 2024, and you're just adding another bar column to the chart, which would be 2025. And of course, we went from 60.7, I'm not sure if this is showing,
This is
based,
just pension.
yeah, but this is, I don't know if it's market value or it does say actuarial value. So we went from 60.7 to 64%. So it is a notable increase for 2025, and I would love for that to be reflected in the PAFR insofar as people review that. So assuming we do approve that, the actuarial report today, and if it is possible to include that, if this has not been physically published yet, I would encourage us to do that.
So on the consent agenda today is for the approval of this.
Mm-hmm.
You could, the motion could be an approval with that proposed update. And if that is the
Okay.
majority of the board wants to do that, we'll go ahead and update that, assuming later on in the agenda,
I was gonna
we
say.
approve the
Mm-hmm.
actuarial valuation.
And we can do that? That's contingent to another approval that has not yet taken place?
Or we
We're gonna
can,
do it. at the end
You,
of the
you
day.
could, you could hold this vote
Yeah,
until
that's what I was
after.
gonna say, let's push
let's
this to
hold,
the
hold
end.
its new business? Okay, so let us hold this for new business,
Yeah.
and then we will
That's where I
be,
was-
Yeah.
at least get that portion of the sequencing correct. All right, a lot of excitement on consent calendar today.
Love it.
You know, not to keep us too lazy.
That's it. Exactly.
Stay alert.
Okay, so with that, let us proceed to item number 3, which is death and survivorship. Please join me in a moment of silence for those who have served the city and who have passed. Okay, thank you. We are now up to investments, and we turn to our CIO, Mr. Palani.
Thank you, Mr. Chairman. Good morning, trustees. We will discuss third quarter performance this morning. Of course, for private markets, it'll be second quarter because it's lagged by 1 quarter. But before we get there, I have some, as always, performance estimates from Makita as of 12/16. Fiscal year to date, we were up 5.48% for the pension plan and 6.77% for the healthcare trust. And of less relevance, but since we are at the end of a calendar year and because the numbers look good, I'll share this too. The pension was up 12.84% calendar year to date. And for healthcare trust, it was 15.57%.
Can we adopt a quick motion to change our fiscal year to the calendar year?
You certainly may.
All right.
I think that's in the city's purview.
The city will like that. There's less money coming into the plan.
We may have to switch it back next year, so let's not.
All right. Unless there are any questions, I would like to invite Casey Boyer and Dinesh.
Great. Are there any questions on that for our CIO? Any public comment on that? No comment, let us proceed.
Floor is yours.
Casey, go ahead.
Okay, great, thank you. I will share my screen quickly. Okay, hopefully everybody can see that. As mentioned, I'm going to be going through performance for Q2 and some really great updates that I hope to convey. So just a quick reminder, the private equity portfolio here is divided into 3 sections. We have investments that were made prior to Newburger partnership, and then we have in the middle 2 columns representing the Newburger series of relationships. So we first started investing with you all back in May of 2017. We have a very consistent strategy through the years, even though we have 2 separate line items and 2 separate series. The same strategy across the board. We are very tied in and collaborative with your team on investment pace, making sure that we're investing each vintage year, and also strategy and focusing on the types of transactions that are best suited for your program. So Series 1 is completely done committing. There's still some capital being called and put into investments, but it's a much smaller amount at this point. The portfolio is maturing, and we have started to see some pretty good distributions. In terms of returns for Q2, if you remember the last few years, it's been pretty stable. There hasn't been a lot of write-ups. There haven't been write-downs, but it's been a pretty consistent performance. Q2, we were up quite a bit, so that was great news. We went from a, let me pull the numbers up so I don't misspeak. We went from a 1.9 times net MOIC to a 1.96. So pretty good movement in 1 quarter. In terms of distribution, that was for Series 1. Series 2 is still actively investing. So dollars are going into companies, into investments, and they are, for the most part, being held at cost and will develop over time and generate returns. In that series, we are at a 1.18 times return, and that was actually stayed the exact same from quarter to quarter, which is pretty good considering new investments are going in at 1 times consistently. One big topic in the private equity, private markets world is distributions, or the lack thereof, over the last few years. In the last 2 quarters, we've seen that within your portfolio go up quite a bit. So in Q1, we returned $2.4 million to your program. In Q2, we returned $3.3 million to your program. And then in September, so post Q2, we actually returned $11 million to the program. So we have seen the underlying realizations and exits come to life a little bit more. And we'll continue to see how that has played out in Q4 and Q3 specifically. That larger distribution was really from a couple underlying primary fund investments that realized some really great returns. We had one specific firm sell a company at 8 times. They sold to a higher, more a larger private equity fund, but were able to generate a really nice return at 8 times. And then we had another primary fund that actually realized their final company. So that fund is actually fully liquidated in about 9 years, which is really good for a private equity buyout fund. So we are starting to see that those returning multiples now, and capital actually coming back to the program, which is a great sign. I'm going to turn to page 11, which is specific to Series 1. So the part of the portfolio that's more mature and kind of harvesting some capital at this point. You'll see the breakout between primaries, secondaries, and co-investments. We typically invest around 30 to 40% of the capital into primary funds and 30 to 40% of the portfolio into a combination of co-investments and secondaries. The write-up for this quarter was really generated primarily in the primary funds and the co-investments, but primaries kind of beat out all of the investment types for this quarter. And that does make sense. As the primary funds are still developing, we are starting to see more return generation in those investments. And you can see here how specifically the net returns jumped from Q1 to Q2 and putting us kind of squarely in the or at the very upper end of the second quartile. Series 2, same information here. Of course, this is the program that's still actively investing, not quite to the point of generating distributions at this point, really just trying to mature and very early in the life of investments. As I mentioned, the net multiple stayed the same quarter to quarter, and we are as well in that second quartile. You can see how additive some secondaries can be when bought at a discount here. Of course, that's a smaller part of your portfolio, so it doesn't necessarily move the needle a lot, but it is a great early beneficial investment for a program and a portfolio like this. So we will continue to look for opportunities like that. And then you'll see co-investments and primaries developing as well. I'm going to pause and see if there's any questions, or I'll open it up to Dinesh if he has anything else.
Nothing further from my end, but please let us know if you have any questions.
Thank you. Trustees, any questions? Trustee Chandra?
I have one. Really for curiosity, that's not leading the witness to anything else. What percentage of our co-investments are with our underlying managers, and what percentage are deals that Neuberger sources from their other relationships?
I would say it's probably 5% existing funds that we've committed to on a primary basis. 95% are other deal flow through the Neuberger Berman private equity platform.
Interesting. Okay, thank you.
Okay. Any other trustee questions? No? Okay. Please proceed.
Okay, that's all we had for this
Oh,
one, so
okay.
we'll move on to the next item, which is Nikita with the private markets
Okay.
performance report.
Maybe before we move on, just maybe a broader landscape question on the primary, secondaries, and co-investments landscape in private equity. So secondaries, I think, I don't want to say are exploding, but just from maybe anecdotal news, is that true? And what's that look like with how Neuberger's making decisions?
Yeah, so secondaries has grown. However, if you look at the broader private equity market, the amount of dollars that have been raised in the secondary market is nowhere close to kind of the market capacity for that type of a transaction. There's still much more primary capital raised, and therefore, a big runway for secondaries. In the secondaries market, a big part of the pie over the last, 5 years has been GP-led transactions. We have found great investments in the GP world. I think you just have to be careful and you have to monitor kind of terms. And so, I think overall that market is doing extremely well, and it makes sense as part of a program. And I think, at this point, when you look at the transactions that are going on in the secondary market, it's about half LP-led transactions, so kind of your traditional buy at a discount portfolio, and then half GP-led transactions. And I think we'll just kind of continue to see that bifurcation between the two types of deals continue. And I think there's definitely room for both And it does add an element and another kind of exit scenario for private equity investments. So overall, we're very diligent. We keep secondaries and co-investments kind of in one bucket. So we don't have to fill a secondary bucket. We don't have to fill a co-investment bucket. We just find the best deals out of both and include them here.
And I would add that we're also highly selective and careful for not just buying for the sake of a discount. There's a lot of cases where there might be a nice discount up front, but then a tail that you need to deal with for the underlying investment that where return just continues to decline in value over time. So it's been our best performing category. So for the overall Series 1 and 2, generating a 41% gross IRR, but only represents 4% of our total commitments. So very selective, but in the cases that we have made those investments, they've done well, both in terms of performance and also returning value with distributions to paid in of 1.23 times. So actually getting cash back from those secondaries.
And are you finding that the existence of a discount is itself a negative indicator for the deal in general?
Not necessarily. It really depends on the particular deal. There's some deal dynamics where maybe there's a situation that many other players don't understand, or it's not being marketed in a way that many of the large secondary buyers who have raised billions, tens of billions of dollars to deploy, and they prefer to deploy in scale. But in these smaller instances, the discount can actually lead to a great outcome. And that is actually some of the cases for our success.
Okay. Any other trustee questions? Okay, let's go to 4C. Thank you.
Thank you.
Thank you, Casey and Dinesh. So Laura Wyrick will address C, D, and E individually.
Triple threat.
Yes, good morning. All right, I'm going to share. All right. Good morning, everyone. This should come up in a second without all of the slides on here. Welcome to the new trustee. I'm Laura Wyrick from Makita Investment Group. In the interest of time, I'll be brief, but just a few words about Makita maybe. We advise mostly on a non-discretionary basis to large institutional funds. I've been with the firm for almost 18 years, and we advise about 250 clients. We have about 250 employees. 75 employee owners, so we're 100% employee owned, and our job is to work for the board with your internal investment team and collaborate on things like overall strategy, investment policy, asset allocation, market research, and manager selection, as well as performance reporting. So that's what I'm here to talk about today. So first, I'll start out with the public report on the total private markets program. So you just heard from Neuberger about private equity in particular. But here we have a total look at private markets in the pension plan. You can see on the right the IRR, or the internal rate of return or money weighted return for each of your individual programs relative to a public markets equivalent. So we calculate this public markets equivalent as if the same amount of dollars went into a public markets index every time one of your underlying managers called capital, and then came out of that public markets index every time they distributed it. And you can see that in general, your programs are doing better than they would have been if invested those same dollars and distributed the same dollars from the public markets, with the exception of venture capital, which is still a program that's sort of in its infancy, having started in 2021, which is immature for a venture capital program. Taking a look at, oh, go ahead.
I think you answered this question for me last time as well, but a reminder. So comparing the public markets equivalent IRR to the fund IRR, what's the kind of expectation you would put on the amount of basis points above the public market equivalent you'd expect with the private market?
That's a good question, and one that we grapple with a lot because benchmarking is very difficult in private markets. And so you'll see some places in this report where we look at peers, some places where we look at a public markets equivalent. Some plans use, for example, public equity plus, say, 200 basis points as a long-term benchmark. It really depends on how the specific investments are implemented on an underlying basis. I would say that, you know, the outperformance in, say, real assets or the Neuberger Fund of One is more outsized than we'd expect relative to public markets over the long term. Some of those dynamics relate to dislocations in public markets, like on the real asset side, whereas some probably relate much more to manager selection and implementation. So we can get more into that during the asset allocation review. Makita puts together capital market expectations, as you know, for all asset classes. And we use 12/31 data. So as of the end of the year, we collect all of that data, put it into our models that we've developed, and go through an approval process. So usually in your February meeting or March, we'd bring the results of that to you. And so typically, you could expect private markets to have a couple % higher illiquidity premium than public markets, but we'll see the updated numbers very soon.
Thank you.
Taking a look at private debt, starting on page 2, you can see that this is a mature program. The allocation to private debt stood at 3.3% as of the end of June, slightly above the 3% policy target. So there were no new investments during the quarter that we're looking at here. And if we look at the individual funds here, we're showing the IRR of each fund on the right relative to a peer IRR, and you can see the vintage year of each fund on the left, as well as the committed contributed capital and a variety of other metrics. Most of these funds, especially the ones that are more recent vintage years but are mature enough to have a return, have done quite well. You can see the geographic focus of the private debt program is mainly North America in the lower left here. It's quite diversified by vintage year, following sort of some large investments that took place 15 years ago or so in 2010. The next program here, you can see the real assets program. This program stood at 2.6% of the total fund relative to a 3% policy target. And there was one new investment, a $7 million commitment to a North American fund during the quarter that we're looking at here. You can see as well here all of the individual funds and returns on pages 11 and 12. And the geographic focus here is a bit more diversified globally, as you might expect for a real assets portfolio relative to private debt, the one that we just looked at. Taking a look at the next program is real estate. It stood at 3.9% of the overall retirement system relative to a 3% policy target. There were two new commitments to Kane Anderson and Cloud Capital during the quarter that we're looking at here, and you can see the individual fund returns on pages 17 and 18. This geographic focus as well tends to focus mainly on North America, and you can see that vintage years are diversified as we would like. The last total program for private markets in this report is venture capital. As I mentioned, it's an immature program, especially for a very long-lived asset class. Right now, the target allocation is 4%, and the actual allocation is 1.5%. There were no new commitments during the quarter that we're looking at here, and you can see the individual funds, many of which are not yet meaningful, listed here on page 22. And this program is almost 90% located in North America. And you can see that there were a lot of commitments when the program started in 2021, but we expect those vintage years to diversify further as the program grows. There are a lot of other slides, about half the document related to the environment right now for private markets. And I know we've talked at other presentations and your IC meetings as well about the current market environment, but I'm happy to take any questions on private markets specifically before moving to the total fund.
Thank you. Trustees, Vice Chair Chandra?
So I believe it's real estate where we are 3.9% allocated with a target of 3, and yet we added 2 new managers. So what was the rationale for adding exposure if we are already above the target?
Sure. So I know Dinesh will have some words as well. There was a pause for some time, but I think there is a view that it makes sense to try to maintain vintage year diversification following that pause. In the past, there was also a slightly higher target allocation to real estate that came down over time, so we're working sort of down towards that.
And it really comes down to vintage year diversification, so we do continue to make commitments even in cases where we're over-allocated in other asset classes in the buyout space. So even though we're 2% in that case over the target, we continue to make investments, however at a smaller pace, so smaller dollar amounts committed, but the intention is to maintain vintage year diversification over time.
And we put together pacing models, as you know, that the board approves around trying to get to and then sort of hover near the long-term targets, since it does make sense to commit as capital is distributed.
So make smaller commitments going forward, and as distributions come back, that will hopefully bring down the allocation. Okay, and this is probably all within policy?
Yeah.
Okay.
And the
I
total
have
fund,
to
as
ask
it
that
grows, just
question.
will be lower.
That's like our main job here.
Yeah.
Great. Any other trustee questions? Okay, thank you.
All right, let me pull up the next report here. Okay. So if we look to the total pension report, I'll start on page 5 here with a brief snapshot of the economic and market environment through the end of September. So I think the magnitude of the returns and the scale here is somewhat staggering. The fact that emerging markets, the top performing asset class year to date through the end of September, was up 27.5%, followed by developed international stocks, the MSCI EFA index up over 25%. You can see the S&P 500 and Russell 3000 U.S. stocks, nothing to sneeze at there, up almost 15%, and even investment grade bonds up over 6%. With real estate investment trusts at the bottom there of 4.5% for the year-to-date period. And then the quarter that we look at in this report is the third quarter, and so those market returns are on the right here, with small cap stocks leading the way, the Russell 2000 up 12.4%. And again, non-U.S. geographic diversification really working quite well in 2025 after the U.S. has dominated for some time. Some of that is fundamental growth in those areas, and a lot of it is also currency movements. As the U.S. dollar has weakened, your existing holdings in non-U.S. currencies became more valuable. And we have a lot of other market slides here. Maybe I'll mention, we did this morning get inflation data for the first time since the beginning of the government shutdown. It fell a bit. The pace of price increases fell to 2.7% from 3% year over year with the last data that we had. Prices are still rising, just not at as high of a pace as they were before. We also received a jobs report recently, 64,000 jobs added in November. That came down from the last report, 119,000 jobs added in September. So I think we did get a quarter-point rate cut recently in December. I think with the slightly cooling inflation data, that may increase the likelihood of another rate cut in the near future from the Fed. That remains to be seen. We have some charts in here on a variety of economic and market factors, but I'm happy to take any questions on that topic before we get into your specific performance.
Any questions? Let's go.
Okay. So as you know, we have the standard exhibits in here around manager watch lists and whatnot for your information. But just to take a look at total asset allocation of your pension fund, you can see that here on page 36. Total fund value at $3.6 billion. I know there were some comments from a member of the public about investment performance. It has been incredibly strong in your fund. I think the board and the internal investment team should be very proud of the investment returns that we've had this year in 2025. The dollars that have been added from investments for the year-to-date period, just the first 9 months of 2025, $380 million in investment returns in your fund. So very strong returns. You can see here that the third quarter alone, so just a 3-month period, the fund had a return of 4.5%. So not really that far from what you're looking for a full fiscal year. You can see that the year-to-date period was up almost 12%, and the trailing 1 year at 10.2 through the end of September. As your CIO noted, the trailing 1 year and year-to-date estimates now fall around 12%. And if you look at the 5-year return here at 9.4, and then we look at that within the peer universe of public defined benefit plans over $1 billion, you can see that that return through, different market environments during the 5-year period hovered right around the top quartile of the peer group. So you can see the individual asset class returns on the next few slides. Recent returns have been driven quite a bit by those very strong public equity, global equity returns. One area I'll point attention to is emerging markets. Your emerging markets allocation has an emphasis on India relative to China. And what drives individual returns for emerging markets in short-term periods tends to be a lot about whether or not India or China are overweighted. So you can see a really strong 5-year average annual return for emerging markets, above median and above the benchmark here. We did see some dominance by China and not India so far in 2025, and that's why you see some relative underperformance, although, of course, 19.2% year-to-date is still a really strong absolute return for this area. But we've already seen that India-China trend sort of reverse in the 4th quarter so far. So if I look at quarter-to-date returns since October 1st through yesterday, China was down 7.7% and India up 2.7%. So a pretty big dispersion there. The India manager exposure in your fund, I expect, will be dominating in your next report that comes out. I want to get into not just looking at returns, but also looking at risk as well. So I like to take a look at the charts that we have towards the back where we look at the 1-year, 3-year, 5-year sort of risk statistics. So focusing on the 5-year here through the end of September, you can see the total fund and its policy benchmark were really highly ranked in the peer group. Your total fund for the 5-year period was 26th percentile. The policy benchmark was 21st percentile. So it's a hard benchmark to beat that you are very close to. And to me, that kind of indicates that the board is doing a good job in terms of selecting an asset allocation, because that's what the policy benchmark is based on. And then if we take a look at risk, the median standard deviation for the second bar here for the peer group was 8.4. That's right where your policy benchmark is that median standard deviation. Your total fund had a lower standard deviation, so less risk than that peer group. And then the two measures on the right here are risk-adjusted return statistics, which look quite strong for your fund over the 5-year period. So I'm happy to take any questions on that brief summary of this 78-page report.
I have a question.
Sure.
And it's probably for another agenda item, but there's been a lot of talk about some organizations like CalPERS moving from strategic allocation to looking more at risk. And I'm wondering if that's something in the future that we could talk about, and what the pros and cons of looking at something like that versus strategic allocation could be as an option for us.
Yeah, that's a great question, and one that we're seeing a lot of headlines on recently, and Makita has assisted CalPERS in that effort. So our co-CEO, Steve McCourt, Makita and Wilshire are both board-level consultants for CalPERS, and so that's something we've been working on. And most recently, I talked to him about it on Monday and got some of the details around how it's going to be implemented in terms of changing the benchmark and things like that. So it is, I think for many funds, doesn't represent a lot of change in the practice of how they're investing. Represents more how they're evaluating their overall plan performance and benchmarking and that sort of thing. So that's certainly a topic we can talk more about.
Okay, thank you.
Any other questions from trustees? Okay. No, not only were the 5-year total returns quite impressive, but even the 10-year returns
Yeah.
are significantly above our discount rate. So very impressive.
Just a quick question. So if I'm reading this right, are Sharp and Sortino's are both top quartile?
Yes,
Okay.
both right around. I think was it 26th? Or let me go back here.
I think it was 26.
28th for the 5-year total fund Sharp ratio, and 25th for the Sortino.
Nice. Thank you.
Mm-hmm.
Okay.
Okay, wrapping up here with performance of the healthcare trust through the end of September. You can see that the fund was getting closer to 500 million at 486 million as of the end of September. And as you know, this is a more risk-taking fund than some peers because it has a relatively high return expectation for a healthcare trust. And in this market environment that was risk-on and dominated by public equities and bonds doing well, you have incredibly strong returns in your healthcare trust. Year-to-date return up 14% in the first percentile of the peer group, trailing average annual three-year return at 3.3, and then 5-year at 8. And you can see the underlying asset classes here as well. And the risk relative stats that we were just looking at for the pension, much higher return than peers, also higher volatility than peers, but still shook out to the risk-adjusted returns being almost in the top decile here.
Great. Any questions from trustees? Any questions from the public on this agenda item? There is none. Okay. Well, thank you for wrapping up the year with such good news.
Yeah, really.
We'll do our best for next year, and happy holidays, everyone.
Yep, just keep it going.
holidays.
Happy holidays. All right. We have no old business, so we'll move forward to new business. Update from our CEO, Mr. Flynn.
Good morning, everybody. First, I'd like just to welcome Trustee Chi. He had the pleasure of spending a few hours with me and Maytech last week doing some onboarding and legal discussions and board operations, and he was a trooper, so welcome. I think first I just want to remind the board that the 2026 schedules obviously will start in a few weeks. Fed board meetings remain the same days of the month, but the police and fire board meetings will be moving to the Wednesday before the Federated meeting. This is really important if you're on the governance committee, because the governance committee meets after the police and fire meeting. So that cadence will change to come into alignment with police and fire, and will also be held, as a reminder, at the ORS office boardroom, because that's where their board meetings are held. Okay, so we received position approvals from the mayor's office to move forward with our overstrength benefits program manager position in the benefits group, and to reclassify our vacant staff specialist position to an analyst position. So work closely with the mayor's office and thank them for their, and budget and HR, and I thank them for their support in that move that was greatly needed by our benefits organization. Our DCIO, or Deputy Chief Investment Officer, request for overstrength has been submitted for consideration. With the plan to request this position to be made permanent as part of our fiscal year 2027 budget. Related to the creation of the DCIO classification, we are working with HR's classification team to update the classification for our senior investment officer position to reflect the creation of the DCIO position and potential reporting structure impacts to that classification. Lastly, we're supporting CMO as they work through the contracting process with CalPERS to add the DCIO position to their contracted positions for the pension. So we have three, with the recent update from the mayor's approval, we have now 3 pension analyst vacancies. We've received over 300 applications that we're reviewing, plan to hold first round interviews in January. Also with the approval from the mayor, the benefits program manager recruitment is underway, with the job posting closing just after we come back from the holiday closure. Fresh off the presses, our investment compensation study is underway, and just this morning I received some raw total compensation data. Still need to review, digest, and internally share that with our executive team. Target potentially the second JPC meeting in January. We should, depending on our interview schedule, might schedule that for JPC discussion at that second meeting in January. Open enrollment has ended. We received over 1,200 open enrollment changes, which represents a significant increase over last year and our previous 3-year average. This may be related to the addition of a new Anthem Medicaid Advantage plan, a cheaper alternative to the plan, which we know generated over 140 changes alone. The increase in rates, the coverage rates combined with the additional plan has also impacted the amount of call and walk-in volume. Our quarterly retirement planning workshop is scheduled for Thursday, February 12th. We've had some good movement on our procurements. Our internal audit service provider contract was signed off by me and just signed off by Risk late yesterday. We're targeting an internal kickoff meeting the second week of January and work with the audit committee chairs to schedule them for an audit committee once we have an onboarding plan completed. We're in negotiations with with 2 independent medical examiners. We have a potential contract with MMRO that was approved by Risk and should be, it is executed and being pushed through the administrative process. And ExamWorks, which is one of our current IMEs, we're still working through getting some paperwork for them so that we can get that filed, although we are running up against the 12/31 expiration of their current contract, so we'll see if we can get that paperwork turned around in time to process through the city's administrative process with the holiday closure shortly upon us. So there is a risk of a small break in service with them. But we have MMRO to fill the gap if we need to. Also happy to report that we have contracted with ABL Tech to be our death match service. Just as a reminder, we run all of our beneficiaries against a service to determine if we've missed any deaths since our last run. This is a way that we protect paying people who are deceased, but we hadn't been notified. This is a service we've had before. ABL Tech is replacing our previous service. Earlier this week, ORS ran our initial file with ABL Tech, including over 7,000 active payees. And with ABL Tech, we identified 4 new deaths that were not identified by our previous provider, one dating back to May 2025. And so, this is a reminder that this is one of the challenges in the benefit payment area. In having a good death match service provider is important. ABL Tech is a new but a leader in the organization that provides, supposed to provide, what's the term, Sandra? Validated deaths. So it's not just they match up against a report, because you get a lot of false positives that way. They're supposed to have validated each of the deaths when they report them to us. So the hope is we're not sending a letter to somebody and they respond.
I'm still here.
Because it creates an administrative burden. Obviously, it creates tension between our staff and the member who is actually alive. And so it's a good service and already producing dividends. So hopefully we'll be able to integrate that. There's some integration issues that we need to work through as with any new provider, but. Strategic planning, trustee interviews have been completed, council member liaison interviews have been completed, staff interviews wrapped up this week. External stakeholder surveys went out to our stakeholder groups on December 10th, and we asked for a deadline for a response by January 5th. So if we have any stakeholders out there that received a survey, please, this is a perfect opportunity for you to tell the boards what's important to you, and to then have that incorporated in our strategic planning discussion. The hope is that early in January, we'll be working with Aon to, Aon will accumulate all the information, try to categorize it and summarize it, and we'll be meeting with them to get something prepared for February for the boards. Suite 560, we're putting the final touches on the space, but it's open for business. Our investment team has moved in, and we started to shuffle staff around on the 6th floor, giving us the much-needed space after our 4-day return to work, return to the office. Just as a reminder, along with the rest of the city offices, ORS will be closed during the holiday closure from December 24th to January 4th. Members will still be able to access their Member Direct portal during this period and submit requests, and there may be a very limited appointments available during that time period. I want to point out, just to point to your attention, the quarterly trustee education opportunities report, which is 8A on today's agenda. It's newly updated. We received that as a quarterly report from Aon as part of their service to us, and it gives you all of the educational opportunities coming up in the next 3 to 6 months, sometimes a little bit further depending on the organization and their published schedules. But if you have any questions or want some recommendations, I'm happy to talk with you about it. And then lastly, I just wish you all a merry holiday season and a happy and healthy 2026. With that, I'll take any questions.
Thank you.
Been busy.
Excuse me. Are there any questions from trustees?
I do have a quick question on the death match. Sorry if I said it wrong.
No,
but
that's how we, internally, it's
Okay.
a little maybe crass, but that's how we refer to it, so.
Okay. I know you mentioned they found 4 more folks than the
Potential,
previous.
yeah.
Did they also actually find the same number that the previous one found as well?
I don't have do you have any stats on that yet, Sandra?
Well, as luck would have it, the old service did not work this week, so we haven't been able to confirm that. I suspect they were deaths in November, so I suspect they would have been caught, but I don't know for sure.
Okay. And just for my own sake, what happens in those scenarios when you find someone that, passed away earlier and then we had made payments?
Sure.
What happens with those payments?
Sandra, do you want to?
I'm sorry, can you repeat that?
The question was, when we find somebody, as an example, who was deceased in May, what is the process that we go through?
Yeah, so then we will immediately stop their pension checks. So for example, we have a December check coming out, so we've immediately stopped that. And then we will reach out through any contact method that we have to find a spouse. I think in this case there is a spouse who would likely be eligible for benefits, and then look at recouping the overpayments from the last 6 months. Yeah.
All right, thank you. Thank you.
And I think what's important to note is ORS is advanced in that this is done on a weekly basis. So we're doing intra-payroll comparisons against these services. I can tell you in my former life, it was a struggle to do it 4 times a year. And we're doing it 4 times a month. Now, some of that is just volume. The results we can handle more. The risk is false positives, as I had mentioned before. And so in my previous life, we would get hundreds of those a run. And you can think of the irate members on the other side of that transaction when we would run it. So we're from a best practice perspective in this area, best practice is to run it before every payroll. The service, the way our service is set up with ABL Tech, we can do it more often and not really experience too much administrative burden, too much additional administrative burden.
I have one more question, and it's more like, does this happen because the money just comes in automatically through direct payment and the spouse just thinks that this is what's happening, or is it because people are in nursing homes, or, what's most likely to be the cause of
I'm
not
going to
being
let
reported?
Sandra comment first, and then I'll add color if needed. If you want,
Yeah, in this case, I think there was a member who lived in Arizona, and from what I understand, Arizona is a closed record state, so finding deaths in that state is a little more challenging. So we have that, and perhaps we're working elderly people, and the spouse doesn't, and the children don't know who to contact, and
Yeah.
perhaps that goes on. Sometime, if there's no spouse, typically the bank account will be terminated, and so we'll find out in other ways. In this case, the bank account wasn't terminated, and that's my guess.
From a spouse perspective, often they believe, or they were told, don't worry, the pension will continue, right? You know,
Yeah.
and so there is no expectation that the benefits wouldn't continue, so they don't understand that maybe they're only supposed to get 50% of the benefit versus the whole benefit. Sandra was pointing out that some states are closed states, and, you know, don't forget San Jose doesn't pay in Social Security, so there's no Social Security, there may not be Social Security connection. And so, and then where I've seen it a lot is when you're out of country, you know, there's different reporting standards, and so, you know, those become a little harder to track.
Right.
Okay, great. Any other questions from trustees? Any public comment or questions? None? All right, thank you so much. Item 6B, which is an oral update from our city council liaison. I know that Vice Mayor Foley is absent. Is there anyone here in her stead to address us? I'm seeing none, so we will move to the next item, 6C. Discussion preliminary results for the OPEB valuation from Chiron.
Mr. Chair, in light of your 10 o'clock time certain, could we switch the order of ours? We may be able to get both of them done, but the
Let's take the short
pension
one
is-
first.
Take the
Yes.
short one first?
Yes.
or- All right. hang on. The short one is the OPEB. So we will stay on schedule here.
Okay.
And
6C.
Jackie will get
Okay,
us
that's,
started
well, that was next in line anyway.
as soon as I share.
Okay.
Good morning, everyone. So today we're going to present the preliminary results for the OPEB healthcare plan. So just a reminder, and next month we'll be back to present the final valuation report and final results. So
Great.
hopefully we don't expect too many changes between now and then.
Mhm.
So we're going to go through. First off, we always like to show this tank, and I know for a new trustee, we'll just explain it quickly. The tank represents like the size of the liabilities for the plan, and how full it is. The water coming in, the water that's in it, that represents like the assets that the plan has right now. So the more assets, the more full the tank will be. You've always got money coming in. You've hopefully got investment returns coming in, and you always have city and employee contributions. And then the money coming out of the plan are your benefits and any expenses that you have. So for the valuation, it's as of the valuation date is the end of fiscal year 2025. We developed the contribution rates, and those are used for fiscal year ending 2027. So it's always a lag in that. What we do for the valuation is we project the benefit payments for the plan. We take the present value of that using assumptions and different methods, and with that we get the liability of the plan, and that we use to set the city contribution rate for the fiscal year ending 2027. And just a reminder, the city contribution rate varies year to year, but the member contribution rates are fixed at 7.5% of pay. So those do not vary between the valuation years. Just to have a look at the membership of the plan. It is a closed plan, so the members that have full benefits, the active participants, that is decreasing over time as expected. And then you have the members that are eligible for catastrophic disability. Those we expect to increase over time. So you can see the blue bar at the bottom is your actives with full benefits. The teal bar at the top is that. When we look at them combined, you are seeing a pretty constant active member population. So that's showing a mature plan right now. As far as total membership, that also stayed pretty constant in the last year. Your full member payroll, obviously we're expecting that to decrease, and that decreased as expected. but your total payroll, that did increase, and that just indicates the large salary increases that were awarded in the last year. This slide, we're showing the changes in the unfunded actuarial liability, and these represent the explicit subsidy only. So looking at it, you can see that the unfunded liability did increase from about 230 million to about 260 million. The biggest driver of that, you can see by the bars that have positive numbers, the big driver of that was the premium changes in the year. So the premiums that came in for 2026 were much larger than was projected. So that caused a big loss and increased the unfunded liability. A couple of numbers that did offset that a bit. You had great investment returns that lowered the unfunded liability by about 21.6 million. And then, of course, you opted to increase your discount rate from 6% to 6.25. That also decreased it. So both of those helped to offset that loss from the premium changes.
So looking at the losses or the changes in the UAL over the last 10 years, you can see the different sources of the changes and how it's bounced around. The net number is shown by the blue line. Just a reminder, down is good, up is an increase in your unfunded liability, and down is a decrease in the unfunded liability. I wanted to isolate a couple things here before showing you the totals. First, if you look at the investment returns, you can see that those have bounced around, but the net over the last 5 years has been very good, driving the costs down. 2021 and 2022 offset each other, but since then, those have been positive. But in addition to investment returns, on the OPEB, one of the big drivers of volatility are changes in healthcare premiums. And that's what's really caused the issue the last 3 years, well, 2 of the last 3 years. But prior to that, we had a significant period of time with good premium experience that was lower than expected and reduced the costs, our expected costs of the plan. If the one other piece that does come in periodically are assumption changes. A lot of those changes are changes in healthcare trends, so they're sort of tied to that premium experience. But there's also other changes, including discount rates and retirement rates are significant for the OPEB plan. The contributions have been a steady source of paying down a small part of the unfunded liability every year. And so that's showing a good, strong contribution policy that we've developed that is working to pay off the unfunded liability. So if we put everything back and look at it over combining those 10 years, that premium bar over that 10-year period gave us a gain compared to our expectations. It's just this last year it was a significant loss. Contributions, that little bit each year adds up and provides a significant reduction. The big increase has come from our assumption changes, which a lot of it was healthcare trend. Putting all of that together, on the left side we're showing the liabilities in the bars broken out. The blue portion is those receiving benefits currently. The gold is members who are no longer working for the city but are entitled to a benefit in the future, and the red are the active members still working for the city. You can see that bar grew fairly significantly in the last year. Those were the changes Jackie was showing, with the premium increases being the primary driver. The assets also went up, but on net, the funded ratio declined slightly from 64.3 to 63.9%. On the right-hand side, you see the contributions. The member contributions are that fixed 7.5% in purple at the bottom. We're showing the normal costs here. On the pension plan, members pay a portion of the normal cost. And the normal cost is the cost of the benefits attributed to the current year of service. In the OPEB plan, the member contributions actually exceed that cost. And so they are paying part of the UAL with their contributions, and then the city's contribution in gold is all going towards paying down the UAL. We had expected the contributions to remain relatively level, but with the increase in premiums, even as it's offset by the reduction in the discount rate and the investment returns, the city's contributions going up from about 21.9 to 24.5 million. So that's all we have on the OPEB. As Jackie said, we'll be back next month with the full valuation and all the details behind it.
Great, thank you very much.
I have
Questions?
a question. Yeah, since you were talking about healthcare premiums, is there something fundamental that's happening that is causing healthcare premiums to increase? Is there something structural, or is it? So what's behind that increase? and are we like, you know, and it's hard to say, but are we in a trend where that might continue?
Yeah, I think we could bring you a better answer next month, because
Perfect.
neither Jackie nor I are healthcare actuaries, but I do note that the PPO Medicare Advantage plan had over a 30% increase in their premiums. That program is highly leveraged because Medicare pays a substantial portion of the costs. So when things go up or down, they can go very significantly up or down. But there are a lot of larger forces out there, and I would just hesitate to describe my opinion of them without checking with our healthcare actuary first.
Okay, I'll ask that question again next time.
Great. Any other questions from trustees? You showed that assumption changes were the biggest driver of increases to the UAL. Of the assumption changes, how much of that was changes to the discount rate versus other types of assumptions?
I didn't track that before this meeting, but my sense of it is we have been at 6 or 6.25 for quite some time. So I think it's mostly other, and probably mostly changes in our healthcare trend assumption, projecting healthcare costs forward.
Okay.
Yeah, I can say that the biggest years, I think if we go back, I think they were in 2020 and 2021. And those were years where you did lower the discount rate. So it does count as a good portion of it. Yeah.
Okay. Okay, thank you. Any other questions from trustees? Any public comment on this item? There's none. Okay, thank you. I think at this time, before we dive into the next subject, which is a little bit meaty, we will take our pause prior to our 10 o'clock time certain. So we are on hiatus for the moment. 1A, which is a disability review for Rosemary Barnes. Are our trustees returned? Yes, they are. Okay. So we follow a very formal script for these disability hearings. Let me first say that I personally do know Ms. Barnes. We were acquainted and worked together when I was a city airport commissioner, and she worked at the airport. But there's no particular reason that I would render a biased judgment or hearing as a result. So is Ms. Barnes present or online with us?
Yes, I am here. Hope you can all hear me.
We
Hello,
can.
everyone.
Can you, and you can hear us?
I can, thank you, loud and clear.
Thank you. Okay, so this is an application for a service-connected disability retirement for Rosemary Barnes. Ms. Barnes, will you be presenting the same information, documents, and witnesses to the board that you presented to the Disability Committee when the Disability Committee heard your original case on September 9th, 2024?
Yes, I will. I have not retained counsel, and just simply here to hear me once again, to help understand my role at City of San Jose's with my work there for half of my career, and how it contributed to my hearing loss.
Okay. Can you confirm that you received, Ms. Barnes, the staff letter dated November 18th, 2025, notifying you of this board meeting?
Yes.
And will you please confirm that the documents in your file are directly relevant to your disability retirement application?
Well, I'd have to go back and look at that. That was, I'd have to go back and review that, but I did receive the documents from Veronica.
Okay, so your understanding is yes?
Yes,
okay.
I did receive them.
Okay. And can you please identify the witnesses who will be testifying on your behalf today?
I will be testifying on my behalf.
Okay. Okay, so I would like to introduce then Counsel Richard Ricada, who is our board legal advisor, to summarize the committee's position, basis for the position, and evidence in the record supporting the position. And his memo is included in the file that all the trustees have received. So, Mr. Ricada?
Hi. It's a pleasure to be able to appear before the board on behalf of the Disability Committee.
Okay, can you pull the mic just a bit closer? Thank you.
And as noted previously, the recommendation to the board from the Disability Committee is that the board deny this application. As background, the Disability Committee looked at the relevant date for Ms. Barnes's application, which in this case was March 2020. And the committee noted that as of that date, Ms. Barnes' status in her position as public information manager at the airport was full duty. There were not then any permanent work restrictions in place. Ms. Barnes is now coming before you to seeking a change in status from her service retirement to a service-connected disability retirement. The body part that's of concern to the board is Ms. Barnes' left ear. As to the right ear, we just note there's no diagnosis, no medical evidence concerning any issues with the right ear, and no permanent work restrictions provided for the right ear. So our focus is on the left ear. Now, as in any disability retirement application, there are two major issues. One, is the applicant incapacitated? And number two, if so, whether the applicant's employment with the City of San Jose contributed in a real and measurable way to the incapacity. Here, however, our issue is more limited. Our issue here, that's the issue before the board, is that of incapacity. The board's independent expert provided a work restriction for Ms. Barnes as to her the hearing loss in her left ear. The department considered that application and concluded in its written memorandum from August 2024 that permanent work restriction could be accommodated. And since the department is able to accommodate the only permanent work restriction that's in the record, it cannot be concluded that the applicant is incapacitated, because the applicant could continue to work in the position that she held. The permanent work restriction that was provided by Dr. Ward, our independent examiner, was that Ms. Barnes should use earplugs or muffler when she is around noise that exceeds 85 decibels. That is the sole work restriction in the record. There's no medical evidence for any other work restriction. And as background, based on only a Google search, 80 decibels is roughly the sound of a garbage disposal operating. 85 decibels is when a diesel truck is passing you by. So so the work restriction is to wear earplugs or ear mufflers when the ambient noise exposure surrounding Ms. Barnes exceeded 85 decibels. And it is that work restriction that the department was able to accommodate. So today, there's no dispute on permanent work restrictions. There's only one that's present. There's only one that the medical evidence supports. There are nothing in the medical records for any other work restriction other than that one. So, so that leads us to the sole issue that I think is in dispute. That is the issue of accommodation. You have before you Ms. Steele's memorandum from August 2024 on behalf of the department that they're aware of this work restriction. They've considered this work restriction. They know the position as to which the work restriction applies. They have the expertise to know and the practical experience to know whether they can in fact accommodate that work restriction. And they concluded that yes, they can accommodate it. So the Disability Committee considered this to be persuasive evidence and provided the substantial basis for their conclusion that yes, in fact, the department could accommodate the work restriction. And based on that analysis, the Disability Committee concluded that this application the Disability Committee adopted as its recommendation to you that this application should be denied. That concludes my comments.
Okay, thank you. I will depart from the script here momentarily just to clarify something here that confuses me. So according to the record, Ms. Barnes separated from service in February of 2020?
Yes.
And in 2024 is when the IME concluded there was hearing loss and a need for accommodation.
Correct.
Is Ms. Barnes seeking to return to service at this time?
No.
Okay.
No, I've had an incredible career with the city of San Jose, 16 years. But I'm happily self-employed, and my small business continues to flourish. Thank you.
And maybe I'll just clarify. She did have a service retirement at that time in 2020, and at the same time put in an application for a disability retirement concurrently. Mm-hmm. And that was during COVID, and we were having some backlogs with our disability processing. So that's why there's a little delay in processing her disability application.
Okay, just wanted
However, if I can comment, the city nurse documented my hearing loss many, many years prior to my service, many, many years before I retired from the city of San Jose.
Okay. So at this time, is the return to work coordinator present?
Yes, I am.
Great. Do you wish to add anything to the memos that your department provided regarding accommodation of work restrictions? Or do you wish to present any other testimony relevant to the issues to be determined in this hearing?
No.
Okay. Ms. Barnes, at this time, please present your testimony in support of your application.
Thank you. I come before you once again just simply to have the city acknowledge how my 16 years of employment with the city of San Jose contributed to the hearing loss. I am more or less deaf in my left ear. I wear a hearing aid, and while it's very helpful for me to use that in the course of business, I typically don't wear it out in the world because in loud environments, because noise can just become overwhelming for me. I was passionate and faithful to my work and service to the airport and its millions of travelers. But the dedication to my work did result in losing hearing in my left ear. It has had a profound effect on my quality of life. Yes, the hearing aid helps. When I didn't have that hearing aid, it really did contribute to impacting my work, especially in the realm of public relations and communications. It is helping me. I look at it as a supportive accommodation for my disability, but bottom line, the city of my work there, both out on the airfield as an airfield operations officer many years ago in my entry-level days, and then moving into an administrative role where I sat in an office with jet engines right outside my window. It did contribute to the loss of hearing in my left ear. It's well documented that prolonged exposure to loud noises such as jet and propeller engines and heavy machinery, and being around where dispersing birds from the runway with the tools that are used for that, it can cause permanent hearing loss. In those early days in operations, we were not required to wear hearing protection. That certainly came into play where that was a requirement many years later, but in my early days in airside operations in the early 90s, it was not a requirement for working out on the airfield. Loss of hearing is not just a medical condition, it's a service-connected injury that impacts day-to-day functioning, relationships, and my ability to work. But I will say the hearing aid that I now wear really has been helpful to me. My employment with the city did expose me to an environment where the risk of auditory damage was not only present, it was unavoidable, as hearing protection was not the standard back then. It contributed to real and measurable damage to my hearing, and I think it should be treated with the same seriousness as any other service-related injury. And I do ask that you honor my commitment to serving the city of San Jose and our wonderful community here. I still live in the city, by approving my application for a service-connected disability retirement. And I do thank you for your time and consideration.
Thank you. Ms. Barnes, would you like to question any of the other witnesses who have testified? What
I'm hearing is that incapacitated to do the work, but what I'm not hearing is how my work, especially in those early days out on the airfield as an operations officer, how that contributed to this loss of hearing. That's not what I'm quite understanding here. Certainly as a public information officer in the role that I was in when I left the airport, and I was not wearing a hearing aid then, I did struggle with my work then, but I guess I'm not understanding how the city doesn't understand how that work, especially in those early days on the airfield when hearing protection was not the standard. I don't understand how we don't understand that has contributed to my hearing loss.
Okay, so this is directed at you, Mr. Requeta, so you can respond.
Sure. I believe Ms. Barnes has provided with a copy of the memorandum that was presented to the board on behalf of the Disability Committee. On page 3 of that memorandum, we specifically address the issue of service connection and agree with Ms. Barnes that her employment with the city of San Jose contributed in a real and measurable way to her permanent work restrictions. But as I mentioned earlier, again, there are two issues before you, two general issues: incapacity, service connection. We agree with Ms. Barnes as to service connection. That is why we didn't. That is.
I'm having a hard time hearing.
Can you speak up?
Can you speak up or speak?
Thank you, I appreciate that.
So we agree with Ms. Barnes as to service connection, and because we indicated that agreement in the memorandum, we didn't think it was a helpful use of board time to mention that today, whereas we think it was important to represent to the board the rationale and the reasoning behind the Disabilities Committee's recommendation to you to deny the application. And again, as I hope I haven't mentioned too much, we also agree there is one permanent work restriction. If the department had been unable to accommodate that, then I think it is quite likely, if not inevitable, that the Disability Committee would have concluded that Ms. Barnes was incapacitated. But the department, on the contrary as to accommodation, concluded in Ms. Steele's memorandum that it could accommodate. So the issue before you is the accommodation. Ms. Barnes is not saying I have more permanent work restrictions, and even if she did, I would remind you that the issues coming before you need to be decided on the basis of medical evidence. And we understand that applicants have deeply felt emotional responses to the challenges, whether auditory or other kind of physical or mental conditions that compel them to bring forward an application to you. And I don't mean to discount that or minimize that, but those strongly expressed thoughts, feelings, beliefs cannot form the basis of your decision. Instead, the basis must be what's in the medical record. The medical record provides a single permanent work restriction, but then we move to the issue of department accommodation, and the department could accommodate that work restriction. And by the way, I apologize, Ms. Barnes, just one Ms. Barnes very clearly and appropriately states that her application and the body part at issue should be treated with the same degree of seriousness and appropriateness that every other body part or condition is treated. And I absolutely agree with that. I'm sure the Disability Committee absolutely agrees with that position. And in point of fact, that is exactly what we've done and in considering this application and coming forward with this recommendation to you.
Okay. Ms. Barnes, you have an opportunity to make additional questions or comments.
Thank you. So the question is, with that accommodation where I'm already have a loss of hearing, and then the accommodation would be for wearing hearing protection. So I'm already struggling with hearing in a business environment. So I guess I'm not understanding how wearing hear protection will then help enhance my ability to communicate in my work. There's a disconnect there for me. I'm already struggling with hearing, and now in order to do in my course of business now, the suggestion is to wear hearing protection, whereas my role, the work I do is communication. So having any type of hearing protection means that I can't converse, I can't hear, I can't respond to what I can't hear. That's another suggestion that I'm not quite clear on.
Just for a slight clarification, the permanent work restriction isn't that Ms. Barnes should wear ear protection 24/7 all the time. No, the ear protection only needs to be worn when she's experiencing or exposed to noise exposure in excess of 85 decibels. So in most communication contexts, meetings, etc., the noise level presumably would be below 85 decibels. And so there would be no requirement or medical recommendation to wear earplugs or other ear protection.
And it was only on the left ear, I believe, only on one ear.
Correct, that's where the hearing damage is, correct.
We'll have a moment for trustee questions. I do want to follow the strict confines of the script. And we're just one step away, which is, at this point, if Ms. Barnes, if you would like to make a closing statement before we open it up to questions by board members.
Sure, thank you. Just to reiterate what I said earlier, here before you to have the city acknowledge my loss of hearing created by my work at the airport, particularly in my early days of airside operations officer, exposed to very loud noise through aircraft engines, equipment, bird dispersal, and ultimately that has what's contributed to the hearing loss in my left ear that really is impactful for me both personally and professionally. I understand that an accommodation has been recommended for future work in loud environments, but ultimately my work at the City of San Jose is the reason for the loss of hearing in my left ear, and my request is for a service-related disability to be given to me as a result of this damage that has been caused to me and my person. Thank you very much for hearing me and for your consideration.
Okay, thank you, Ms. Barnes. So at this point, are there any questions from board members to any of the witnesses that you would like to put forward? Trustee Nakagawa.
Yes. One question. For the, I guess for the restriction, you had mentioned that it was only, again, to the left ear that had the permanent work restrictions, and the right had no permanent work restrictions. So just a question on the accommodation, to where the hearing protection, is it just over the left ear only then?
Yes.
Okay, so the right ear would have been, simply put, open and fine, and the right ear would be unrestricted at that point, right?
Whereas, and I'm looking at the report by the board's independent examiner, Ronald Ward, in his July 31st, 2024 written opinion. He didn't he was focused on the left ear, so he didn't put the negative that the work restriction doesn't apply to the right ear. He was only focusing on the left ear. But notice in all the material, there's no hearing loss on the right ear. So there'd be no need for the ear protection in the right ear. Now, obviously, if that changed, I think the measuring tool is an audiogram. If audiograms in the future showed damage to the right ear, then I assume that medical recommendation would change. But we have audiograms summarized in Dr. Ward's report from 2019 to 2024 showing a certain amount of sensory neural motor loss in the left ear, but none in the right ear.
Okay, thank you.
Are there questions from any other trustees for any of the witnesses?
I
Please.
have a question, and what are the criteria for granting a service-connected disability? If you could just sort of reiterate that for us, because I know in some cases it's permanently not being able to do any kind of work, and perhaps there's a different kind of standard here, and it sounds like she could work with accommodation, so.
Sure. Let me. I'm sorry, I wasn't helpful in answering that previously. Again, the board has two issues that it has to decide in the affirmative. It has to say yes, that the applicant is incapacitated from the performance of the duties of his or her position. So incapacity is issue number one. If the answer to issue number one is yes, the applicant is incapacitated, then that leads to issue number two, which I sloppily will call the causation issue, but that's not really the right way to phrase it. Based on California Supreme Court precedent, the next question is, did the applicant's employment with the City of San Jose contribute in a real and measurable way to the incapacity? And then a subset of that is, if the applicant otherwise had some type of condition, did the applicant's employment with the City of San Jose aggravate make permanently worse in a real and measurable way the applicant's incapacity. So those are the two legal issues as mandated by the San Jose Municipal Code. And so those are the focuses that we have. Now, does that adequately answer? But, oh, and I apologize, I didn't get to
Yes, it does. I just want, it sort of sounds like she has to be, we have to fulfill the incapacitation requirement first, and then we consider the other issues.
I mean, logically, though, in our reports, just to sort of address the whole waterfront while the case is before us, even though in this case we decided, based on departmental accommodation, that there's no incapacity, it still was sort of just practically useful to also address the second element, even though logically it comes only after the first one is answered in the affirmative.
Thank you.
Can I ask a couple of questions?
Please.
I'd love to hear from the Disability Committee. Presumably you guys have had a chance to review, and I'd love your opinions. And then I have a follow-up that's probably in the same vein as Trustee Abbott's for Russ, but I'd like to hear from the committee first.
And let me dive in, because I think along similar lines, I have some questions. I'm having trouble understanding this. So before Disability explains your logic.
Then let me ask my second question.
Okay,
It might not be. Oh, go ahead.
Maybe mine bears on yours.
Yeah.
It seems we agree that her disability was caused by work at the city, and she is no longer working for the city. So this accommodation is for the work she does now outside the city?
No, I certainly understand the point you're raising, and it's one that many past board members have raised.
Okay.
Because it seems odd that we're looking back at a point in time, not the present, and that several years, in some cases many years, can have elapsed between the point in time we're directing your attention to and the present. And this is one illustration of that. But we're not the accommodation, and you could say it's somewhat of a time machine kind of exercise, but the municipal code sort of mandates that exercise, because the Muni Code requires us, or if an application is to be approved, to conclude that as of the date of separation from service, when they're no longer an employee with the city, so that in Ms. Barnes' case is back in March of 2020, that at that time, Ms. Barnes was incapacitated, and her employment with the city contributed in a real and measurable way to that incapacity. So we always have to look back at a point in time, and we make that very clear in our submission in the letters, or the letters of instruction, and the questions that we propound to our independent medical examiner for them to focus on. We do that in every case.
So I can follow up. At that point in time, which was February 2020, are you stating that although her incapacity was a result of her work at the city, because it could be accommodated, she's not entitled to a service-connected disability?
And not to quibble, but use the term incapacitated. Now,
okay,
that's sort of the pot at the end of the rainbow. That's the ultimate conclusion.
Mm-hmm.
Steps along that way are, does she have permanent work? Does an applicant have permanent work restrictions? And that's on the basis of medical evidence. And depending on the case, you could have workers' comp doctors saying, yes, there's permanent work restrictions, as of the time they did their report. You could have primary reports from primary care physicians saying, yes, this person due to this condition has permanent work restrictions. And then, as part of our due diligence, we send it out to an independent medical review, and that medical reviewer could say, no permanent work restrictions. Well, what do you do then? I mean, obviously, then the committee, and then ultimately the board, has to weigh the conflicting medical evidence. Those are tough ones, because obviously none of us spent as much time in medical school as perhaps in retrospect we wish we had. So we're not medical experts, but that's still your job. And then you ask your advisors to provide comments and perspectives that hopefully help you do your job. But luckily, that's not this case. You do not have conflicting medical evidence. So that element of complexity is absent from this application.
If you need a follow-up.
Well, or let's hear from the Disability Committee and hear their logical thoughts.
My second question probably is better now, so
All right.
let's reverse that after
have
you
that.
spoke. Okay, so we're establishing that her hearing loss was in part a result of her employment with the city and the role she played. So I guess I don't know how to frame my question. I'll just try and do it by analogy, if that's okay. So if I'm an office worker in the city and something falls on me and I have nerve damage in my left hand, but I'm right-handed and I can still continue to do my job, is there some other avenue through which the employee can get damages for the fact that they now have a permanent, because I wanted to establish that, is there a different channel for that?
Yes, there'd be, the proceedings before you are separate and independent from any claim the individual might submit to the city with respect to workers' compensation injuries. So individuals can eventually agree to monetary resolution of their of any work injuries that resulted from their employment with the city. And some of that can include, sometimes they reduce the monetary recovery, or the different types of monetary compensation that can result from the workers' compensation process to a lump sum financial payment. But separate and apart from that, under the workers' compensation system, they can get future medical coverage for medical treatment for that injury or condition caused by or to which their employment substantially contributed to the condition.
Okay,
so there is a separate mechanism available.
Thank you. That was helpful. And it may be immaterial to this proceeding, but has that actually happened in this case?
I personally don't know.
Okay.
I assume so. I forget if the earlier report from Dr. Smith that you have from 2020 is.
Okay, it wouldn't affect the decision necessarily. So if Disability Committee would want to address their logic?
I can start with that. We do look at two things. We look at, was there a situation that caused a disability, as it were? It can be any number of things. And then we look at, can the city, and keeping them in that same job, is there a way to have an accommodation so that they could continue to work in the job they're in? Sometimes the accommodation might be an arrangement of a different assignment, but primarily it is an accommodation for that particular work. So we look very carefully, and if you look at the track record of the things that we have agreed, there was no accommodation. The department could not do what the accommodation was. Here there was accommodation that could be made to do the position that she was in. And that's why I voted to deny the disability request. We didn't deny the disability, but we did see that there was accommodation that could be made to carry out the work. And so that's why I moved in that direction. I'll see what the others.
Yeah, I can only reiterate a very similar topic, that as a committee, we're very empathetic to anyone that has any issues that stem from employment at the city of San Jose, and we agree, as Russ has mentioned and shown on page 3 of that letter to the board, that there's real and measurable hearing loss related to this role for the city. But we're also a little bit hands tied, where we follow the Muni Code, we follow the law set in place for us to what qualifies as a disability retirement. And that component where Ms. Steele's memo works with the department, works with the equivalent positions, and that varies depending on what role it is, on if they can make an accommodation that captures those permanent work restrictions and allows the employee to continue in that role. If they can, meaning they can accommodate all those permanent work restrictions, then that's the end of the story. For following procedures to try to be as fair and reasonable to all members, we can't deviate from that, even though we might think, gosh, that's such a bummer. We have to follow the rules and protocols set in place for us that qualify what is a disability retirement. So that's why as a group we denied or recommended denial of the case. Has to do with being able to still continue in the work.
Thank you.
Any other questions or comments from trustees?
I will make one more.
Okay.
I think it's useful for the board while we're talking about this, that as the disability committee, it is the burden of proof lies in the hands of the applicant, not in terms of the board or the committee to try to uncover things for them. So the applicant, I believe, knows that and is mentioned many times that they have to provide everything that they can that helps us make the decision. We can't try to find a way to make a decision. Now, that would not have necessarily changed the outcome here, but we rely simply in all these cases on what is provided to us.
Correct. Thank you.
And we rely on the independent medical exam.
Okay. Right, if there are no further questions from trustees, the hearing itself is closed, and now the trustees will deliberate and decide our course of action. So, as Trustee Faulkner pointed out, the burden of proof per se is on the applicant, and to show good cause for why this initial rejection of the application should be rejected. I don't know if anybody would want to comment on how we should rule in this case. I have some comments I can put forward. So, Trustee Nakagawa.
Yes, I have a comment. I was not I'm on the disability committee now, but I was not at the time this was presented. But,
Okay.
in reviewing the information, my understanding again is, as they had stated, the Muni Code says, there's 2 requirements to grant this. It's incapacity and then service connection. I think, to summarize, no one's disputing the service connection element of this, right? It was caused in a real and measurable way by her work at the airport. I think the question, again, is the incapacity, right? As Ms. Steele noted in her note, right? As of the date of separation, which is the key date, as Russ said, you're gonna go in a time machine, but as of March 2020, her one and only work restriction was to the left ear, and that was clearly noted by Ms. Steele that the department could accommodate. So, in effect, I believe she could have continued her work in her present role at the time had that been the only work restriction. So, and as was noted, right, the burden of proof is on the applicant. So, just wanted to provide those comments.
Great, thank you. Any other comments from trustees, questions? It seems to me what's at issue here is interpretation of the municipal code. There doesn't seem to be much dispute about medical evidence. There's no dispute that her injuries were at least partially caused by her work for the city. I think Vice Chair Chandra's question got to the heart of the matter for me and my confusion, which is whether or not the avenue for compensation for those injuries is a service-connected disability. And from what I understand, according to the municipal code, this is not the avenue for that. There are other avenues for compensation for the injury that she suffered. It's unfortunate that she did suffer that and her work for the city, but the question is whether or not she is entitled, according to the municipal code, for service-connected disability. And the fact that her disability could be accommodated means that she is not. So that is my understanding. Now, I'm getting a flag that there's a public comment. I'm not sure, is this an issue on which the public is permitted to comment?
Yes.
It is, okay. So I will accept that public comment. Again, that's limited to 2 minutes.
We have a public comment from Mr. Brad. Mr. Brad, you have minutes and then you will continue.
Very good.
Thank you, and thank you, Mr. Chair. And a rousing hello to Mr. Russ Ricada. I hope we can get reacquainted at some time. So I'm glad you're still in circulation. But anyway, I think the Disability Committee acted in good faith. I hope the board accepts their findings. If I could use, since we're in the football season, if I could use the analogy. Oh, first of all, please clarify whether or not, if the board grants a disability service-connected retirement, does that affect Ms. Barnes' overall pension? And I know there are some IRS tax implications of this, but that's beyond the board's purview. But anyway, I think I kind of view this as a kind of a Hail Mary. Let's try and bring it to the board and see what happens. Maybe it'll change. But I think the Disability Committee acted responsibly, and thank you for allowing me to speak. And again, Merry Christmas and Happy New Year.
Thank you.
It might be helpful to explain the question that Brad raises. What impact does this have?
Okay, I will address that. A service-connected disability would increase the pension delivered to Ms. Barnes. No. So that would have a material impact. No, that's not the case?
No. So for the service-connected disability, there's a minimum for Federated of 40% of your final average salary, which is about 16 years of service. If you maybe see in your records, Ms. Barnes had a little bit over 16 years of service, so she's already over the minimum, so there would be no increase in her pension. The service-connected disability is also eligible for IRS tax break, so she would be eligible for that if this was approved.
So that's the principal issue.
Mm-hmm.
Very good. Okay. None of that should affect our deliberation on whether or not this is she is qualified for the service-connected disability, but it is information. Any other questions or comments? Any reaction to my understanding of what's at issue here?
No,
Okay. So I guess at this point, then, we have a vote, or do we need a motion and vote?
Yeah, I think we need a motion.
Okay. Would someone like to formulate a motion?
I will formulate a motion and add some dicta to it. The formal motion is to approve the Disability Committee's conclusion or decision, and also then my sincere hope that the applicant is pursuing the other paths that she has for damages.
Okay, is there a second for that motion?
Second.
I have a second from Trustee Faulkner. So with that, again, normally with a motion, we would permit public comments. We would have no comment from public, trustee discussion on the motion. If not, we can vote. So the vote is to uphold the Disability Commission decision on this item and encourage the applicant to seek other means for compensation for the injury she has suffered. All in favor?
Aye.
All opposed? Thank you so much for hearing this. Good luck, Ms. Barnes, and we hope you do receive compensation for the injury, and we appreciate your work for the city. Thank you.
Thank you. So great to see you all. Happy holidays. Appreciate your time.
Thank you.
Bye-bye.
Okay. We will now move forward with the agenda, and we turn once again to the good folks of Chiron.
Actually, could we take the other disability case before we?
Oh, I was going to do that under new business. So, under the consent calendar, we pulled out item 2-1A, which is the disability case for Veronica Andrade, and that was a question where there may have been some typo or misinformation in the memo. And
So Russ, do you want to address the case?
As the unfortunate author of the memorandum who committed the error, which I better make quite sure I don't commit in the future, the footer of the memo in bold and in caps had the wrong name because I used a prior form. And I very much regret doing that. I very much apologize for doing that. And I really, really will exercise much more due diligence to make sure this doesn't happen again. But for what it's worth, in the heading of the document, in the caption of the document, and everywhere where the applicant name was set forth in the document, that's correct. But that doesn't negate the fact that the header was incorrect and included the wrong person, for which I do deeply apologize. But I would defer to the board and to the board's counsel as to the impact of this. I would only submit that the substance of the memo was accurate and named the correct applicant. But the footer was on, and the footer, as is the case with footers, was on each page of the memo and therefore incorrect at the bottom of each page of the memo. Self-serving comment from the guy who made the error. I don't think that a reasonable person would have been misled by the error I committed, and that's the position I'm going to take with my malpractice insurer.
You're safe.
So,
I don't think we'll be making a claim, Russ.
So with that, I will entertain a motion to accept the body of the memo with the deletion of the footer. Is there any such motion?
I so moved.
We have a motion from Trustee Abbott, a second.
I'll second it.
A second from Vice Chair Chandra,
To clarify the record, what is the motion exactly?
to accept the memo.
With the correction of the name at the bottom.
So we are,
That's a deletion of the footer, right?
Well, it could be, you
However,
could delete, you
yeah,
could delete the
correction of the
footer,
footer.
or
Deletion.
you could simply change it from Eunice Wilson to the recipient's name.
insofar as the,
I don't know whether they need to have the footer at the
I
bottom.
think it's probably not material to the memo, so to simply delete might be the easiest
Okay.
thing. And this is to accept the application for change
Yes,
based on the memo so amended.
yes.
Again, just for the record, it's to accept the application and the committee's recommendation of denial.
Yes.
And my second stands.
Your second stands. Excellent. Any further questions or discussion?
Nice work, Debbie. Attention to detail.
Yes.
I've been reviewing finals. I've been like on it.
Mhm.
Yeah.
Okay. Any public comment on this item? No comment. So we can vote. All those in favor of the motion, which I won't describe again.
Aye.
Passes unanimously. Thank you.
Thank you for our indulgence.
Thank you. And thank you, Trustee Abbott, for attention to detail. We should all learn from that. And now, at long last, we return to our actuaries for item 6D, which is discussion action on final results for the actuarial valuation.
Morning. So we're back Talking about the pension valuation results, we have the final results of the 2025 valuation. We've already covered the preliminary OPEB results, and in January we'll be back with the final OPEB results, but that's the end of the actuarial calendar. We went through something similar on the OPEB valuation of how the valuation works. So I'll just hit this briefly, this dynamic here. Fundamentally, the contributions plus the investment earnings over the life of the program have to add up to the benefits and the expenses. And so in the valuation, what we're focused on is developing the contributions. And to do that, we start with a projection of all the future benefit payments based on our assumptions. Applying actuarial cost method and assumptions, we develop a funding target, which is represented by the size of the tank. We compare that funding target to the actual assets in the pension fund and use that with the contribution policy to set the member and city contributions.
So a few last slides in this presentation. You already saw them at last month's meeting for the preliminary results. So we are going to focus a little bit more on anything that's new that we're presenting. But for the benefit of the new trustee, we'll just touch on some of these that we already presented last month. So this being one of them, this slide, just like in the OPEB, it shows the bars represent the liabilities in the plan. The lines in the chart show the assets. I think the key takeaway from this chart is the funding ratio for both the Tier 1 and the Tier 2 increased in the last year. So for the Tier 1, it increased from about 59.4% to 62.9%, and Tier 2 increased from 90.2% to 94.5%. So on both of those, and then in total for the plan, increased about 61% to 65%. These are some more charts that we saw in the preliminary results last month. They're focused on the unfunded liability, the changes from year over year. Just to reiterate, just like in the OPEB, the contributions and the investment gains help to lower it, but those did not get offset by any liability experience. The liability experience in this, which resulted in a loss in the plan, was really attributable to the large salary increases that we saw in the last year. So, but in general, you had a decrease in your unfunded liability. You can see from 2.201 million to billion to 1.9. And then again, the chart to the right, that just shows that the breakdown of the unfunded liability, the changes over year, and for the 10-year total. You can see the big ticket numbers there on your investment gains and losses. Again, assumption changes, which tie to when we have usually do experience studies. We change the demographic as well as the economic assumptions. And then you can see the liability changes. Over the last 5 years, in particular, you can see that there were large salary increases, which caused those losses on the liability side, but you had some great investment gains offsetting that too. This slide, we're focused on the funding ratio, and this is a new one since the preliminary results. We do the valuations. We always like to compare the fund to other public plans that are out there. So on the left, we've got the National Public Plan Survey, and on the right, we've got California plans. So on the one thing to look at, these show the percentiles of the different plans within the thing. So each bar ranges from the 5th percentile to the 95th percentile. And you can, one thing to take away from this is that, well, two things. The gold diamonds, they represent this plan by itself. And then the black triangles, those represent San Jose combined, so Federated combined with police and fire. You can see on both national basis and a California basis, when you're comparing the funding ratio of this plan out there, you are in the lower quartile, so that being the 5th to the 25th percentile. So that's just one thing to note. In comparison, your funding ratio is low compared to other plans out there. With that, we're going to move on to the contribution rates of the plan. So in the preliminary results, we did, this is just more, we did show these numbers, but this is more broken down. So we did show the member contribution rates, but the city contribution rate here, we've broken it down. You have your normal cost portion, because the members only pay a portion of it, so the city pays the rest of it. You have that small city admin expense breakout. And then you have your big, a big percentage of the city's contribution comes from the UAL. So you have two parts of that: the interest that you're paying on the unfunded liability and the principal that you're paying down. So you could, looking at this, your interest on the UAL is decreasing, and you're paying down more of the UAL principal, so that top part of it. So on the left, we've got the rates, and on the right, we've got as a dollar amount. So one thing to note, on the dollar amount, you're seeing like that increase there, and that's really coming from the increase in payroll as a total for the plan. If we broke it down by tier, a lot of the contribution you're going to see it's much more, okay? So the difference here is that you have that higher contribution rate, but you have that lower payroll basis. So because it's a closed tier, the payroll basis is decreasing, but you're having that the allocation of the unfunded liability is still a big portion of it. And then if you look at tier 2, the unfunded portion is very low right now. And even though you've got an increase in payroll there, the unfunded portion is much smaller. So we're looking at the projections. So we've got, in these charts, we've got historical and we've got projected numbers. So everything to the left, that's a lighter bar, that's historical. Those are numbers that actually happen, and everything that's a darker bar in both charts, that's what's projected to happen. On the left, we're looking at the funding ratios. So the bars represent the liabilities of the plan, the assets are represented by the line, and then the percentages at the top is the funding ratio. You're looking at also for the liabilities, it's broken down by tier 1 and tier 2. So you can see tier 1, it's increasing a little bit, but then it's over time it will decrease, and you've got that tier 2 is becoming a much larger portion of the liabilities. And if all assumptions are met, including the assumed investment returns, as well as all the demographic assumptions of the plan, the funding ratio is expected to get to 100% by 2040. On the, just on the graph, we'll go back one more. Just the graph on the right, that's your actual unfunded liability dollar amount. You can see it oscillates a little bit more. It's very dependent on your investment returns as of that date, because we look at it on a market value basis. But based on your contribution policy, it is expected to decrease over time too. And that correlates with getting to that 100%, which is when that'll get to 0. So focusing on the amortization payments, one thing to look at this is this really attributes a lot to that unfunded liability portion of the contribution that you've got. So just a reminder that for tier 1, your amortization policy is a 20-year layered amortization. For tier 2, it's a 10-year. So each portion of these of these bars represent a different base that has been created. So you get a new base each year, and each year that new base gets amortized over 20 years for Tier 1 and Tier 2. Looking at this, you can see that there's that pink bar right there. That's your biggest amortization payment right now, and that's attributable to the 2009 UAL. And then you can see over in 2041, that suddenly disappears, and that's when that amortization that base will be fully amortized, and that's when you're expected to see a large decrease in the amortization payment amount. So. Yeah, if you want to look at Tier 2, you don't have that old base. Tier 2 was created afterwards, but you can see the different, first of all, the scale here is very different for Tier 1 versus Tier 2. So it's not that because you see the larger bars here that in comparison, it's quite small compared to Tier 1. But if you look at here, this is driven a lot by assumption changes. Your gains and losses kind of offset a little bit, but you can see the purple bars. That's when you make an assumption change that it creates a larger base. So just going back to the contribution percentages, so in the earlier slide, we saw it broken down a lot more. Here, we've got it more as the member versus the city contribution. This is the projected number. So you can see for, right now we're just showing the projection for 1 year. So you can see that your contribution rate, the member rate is set, but the city contribution rate is expected to decrease. But on a dollar basis, it's expected to increase, and that's just because of the larger payroll basis that you're looking at. Again, we can look at it historically. It's oscillated a little bit, but in general, the contribution rate has been decreasing, but your contribution amount has been increasing. Again, all correlates to payroll increases. If we're looking at the projected, your contribution rate is expected to decrease over time. There are some points in time where it'll increase a little bit, but what you can see is that large decrease in 2041. That's when that 2009 UAL amortization base is going to get paid off. As far as the contribution, the dollar amounts, they're expected to continue to increase as salaries increase, but you will see that big drop in 2041 with that base. And then just to look at them, when you look at both the historical and the projected, you can see you really do have that good decrease on your contribution rate. In total, it's been decreasing and has continued to expect to decrease. And then the contribution amounts, again, they're expected to increase like they have been, but then you are expected to have that large decrease.
So I'm going to get into some stress testing on the plan and the projections. One of the issues that drives this stress testing is how mature the pension plan is. And you often think of a mature person as being very stable and able to handle adversity. A mature pension plan is the exact opposite. It's sort of, I guess, with current events, I was thinking it's sort of the Archie Bunker maturity level. And so maturity is something that we monitor for the pension plan to understand its sensitivity to the risk. And the easiest way to get a basic understanding of it is looking at this membership trends, and in particular, the ratio of retirees to actives. And so here we're showing that ratio, we call it the support ratio, is the red line. And you can see with the Great Recession, that increased dramatically from, it was 0.6 in 2005, 0.7 in 2007, and then it increased quickly to about 1.2, and then held steady. But now with some of the increased hiring at the city, that has come down a little bit to 1.1. So there's actually been some progress reversing that trend. over time, we expect that to increase gradually up to a point, but it's the stability of the growth of new membership versus the growth of retirees that causes the dynamic. Now, that ratio doesn't provide any quantitative information that's useful in analyzing the pension plan. So we look at two other ratios that really do translate. The first one is the asset leverage ratio on the left-hand side. And we're showing a comparison to other plans across the country in the public plans database of what this ratio is. The ratio is simply the market value of assets divided by payroll. And that ratio shows you your sensitivity to investment risk. So just to give you a simple example, assume that ratio was 5 and you incurred an investment loss of 10% compared to our assumption. So about a little over -3 actual return. That loss would be 50% of your payroll, 10 times the 5 ratio. For a plan that had a ratio of 10, that loss would be 100% of its payroll. And so when you go to pay for that loss through contributions, the plan that has a ratio of 10 is going to have to pay twice as much as the plan that had a ratio of 5. And so it will end up being twice as sensitive to that very same investment loss. Now, it also works with a gain, right? So it's just overall sensitivity. So the plan with a ratio of an asset leverage ratio of 10 will see a much bigger drop in their contribution rate for a 10% gain in their investment return. So it works both ways. You can see the Federated plan is the gold diamond, and you're in the third quartile, the upper quartile, but not the top quartile. So you're more sensitive than most plans nationally, but not the most sensitive. The police and fire plan is actually off the chart on the top, and so when you blend them together, you end up in that black triangle, and very much one of the most sensitive in combination, one of the most sensitive to investment returns. Now, that asset leverage ratio is going to depend on your funded status, right? And we're only 65% funded. So if we were 100% funded, it would look like it does on the right-hand chart, which is the liability leverage ratio, where we just take the actuarial liability and divide by payroll. And on that ratio, you can see the Federated plan has been near the top by itself, not even taking into account the police and fire plan. That has come down substantially as the Federated payroll has grown. Even as the assets have grown, the actuarial liability has grown, but the payroll has grown faster. And so on that measure, you're less sensitive than you used to be, but you're still fairly sensitive. Now that has an immediate impact for assumption changes. It measures your sensitivity when we change assumptions. And then ultimately, when you get to 100% funded, that would also affect your investments. So those are the two key measures we are looking at in terms of maturity. And then just to show you kind of how that might translate, on the left-hand side, we're showing the impact of a change in the discount rate. So the left bar is the bar Jackie showed at the beginning here of the contribution rates at 6.625. If we drop the discount rate 100 basis points, that would immediately increase the city's contribution rate to 55.1. But notice it also increases the members' contribution rate from 8.1 to 10.5. So changing the discount rate is going to change the normal cost, which is also shared between members in the city, as well as the UAL payments. On the right-hand side, we're trying to show what happens if you have a really bad investment return just in the first year. And so we're showing the fiscal year end 2027 rate is again what Jackie showed in the earlier slide. We added the expected for fiscal year end 2028. And then what if we had a minus 20% investment return for the year? What would it do? Well, keep in mind, we smooth assets, so we would only recognize 20% of that. But even recognizing 20%, that would increase our contribution rate immediately by 4% of pay. But then you could expect similar increases over the next 4 years. Yeah.
Bill, this is just for Federated, right?
Just Federated.
Now, going back to the previous chart on sensitivity, right? The leverage, sorry, not sensitivity. Why is the black diamond important?
The black diamond is important because it shows the sensitivity to the city as a whole.
Sure.
It's combining the two plans.
But when this board makes a decision, it should only take into account its own leverage.
Yes.
Yeah.
It's just to provide the context for the
Okay.
city as a whole.
Got it. Thank you.
Yes. So to stress test, we create some very simple scenarios. They're not intended to be realistic scenarios, but to give you a sense of how investment returns could affect the contributions. And we develop them based on the distribution of expected returns over a 1 year and 5 year period. And so the 1 year shock scenarios, we take the 5th and 95th percentile returns and apply them for 1 year. And then after that, assume we just go back to our assumption. For the 5 year moderate scenarios, we take the 25th and 75th percentiles and apply those for 5 years and then back to the assumption. So that 25th and 75th, about half of your results should fall between those, just to give you kind of a rough parameter here. So here we have our baseline projection. The graph on the left is a little different than what we've shown earlier. Here the assets are shown in green and the unfunded liability in red. And so we could actually take that off and you see that unfunded liability chart pay down that Jackie showed. The baseline blue line on the left is showing the projected level of assets in our baseline projection where all assumptions are met, including the 6 5/8. And so on the right-hand side, we're showing the contributions split between the member and the city. And the blue line, again, is showing that baseline so that you can see when we go to the other scenarios how everything changes compared to the baseline. So if we do that 1 year negative shock, you can see you have a significant drop immediately, and it would reduce the funded ratio from, we were expecting 68% next year, and that would reduce it to 55. So that's a pretty significant difference.
Is that based on market or actuarial?
Market. But then it's projected to recover because we only have a 1 year shock and then we build up contributions and it recovers. And on the right-hand side, you can see that buildup of contributions. The first year, the additional contributions are pretty small, but it steps up over 5 years and builds to a much higher contribution rate for the city. Under the baseline scenario, the city's contribution in 2033 was $264 million. This would increase it to $323, just based on that 1 year of a minus 12.5% return. Now that's a pretty significant negative return. On the flip side, if you have a positive return, you can see on the right-hand side how much it reduces the contributions for the city. It does have a minor effect on member contributions through the Tier 2 member contributions, but there's a minimum contribution equal to the normal cost, and so the Tier 2 contributions can't go down very much. The red bars that are down below here, that's a surplus. That's the amount we would be over 100% funded. If you look at the 5-year moderate on the negative side, it's a similar sort of thing where the unfunded continues to grow during that period, and then we work through the higher contributions to pay it back off and get back on track. And similarly, with the 5-year positive, it more gradually reduces the contributions, and we develop a surplus. Now, all of these scenarios assume we make no changes to our funding policy, no changes to the investment policy during the scenario. So keep that in mind, because especially if we become 100% funded, we might make some changes. So those scenarios are helpful for kind of understanding the dynamics and how things work. This is a stochastic projection where we generate 10,000 trials of different investment returns and then show the range of outcomes. And so you can see we've got the gold line shows the historical contribution rates, and then the projection going forward, the bars show the range of potential contribution rates, with the median being between the green and the blue bar, that breakdown. And so that median follows very closely the projections we have under the baseline as a percentage, as a rate of pay for the city contributions, gradually declining and then dropping off in 2041. But you can see there's quite a range. I will say, I know most of you probably were not watching the Police and Fire Board meeting, but I just want to say on this version for the Police and Fire Board meeting, I pointed out that the green area was much smaller than the blue area. So they have a much higher risk of contributions going up and not going down. That's not true for Federated. And so it leads me to very different conclusions, and that's why I say different things at the Federated Board than at the Police and Fire Board. There's, I don't know, it looks like the green area may actually be larger than the blue area for the Federated Board, meaning there is significant potential gains from investment returns as well as losses when measured in terms of contributions.
And is that because our asset allocation currently is slightly more risk welcoming?
No, it's mostly because you're 65% funded and they're 88% funded.
Okay.
And so good returns for them get them to 100% very quickly, and the contributions can't go below normal cost. So they're sort of stuck at a minimum contribution rate. They don't get the same benefit from additional investment returns that you would get. There are some differences in your policy and the volatility and all of that, but the main difference is driven by the difference in the funding levels.
Okay.
Here, we broke that prior chart out between Tier 1 and Tier 2, just to make it clear that almost all of the volatility is on the Tier 1 side. The Tier 2 rate is just barely above their normal costs, so there's not much of any room to go down. They do have room to go up, but they're much smaller in terms of the assets and liabilities, and so the variability is much smaller. And then here on the left-hand side, we're just doing a projection of the UALs. So starting, we're right at 1.9 billion now, but you can see if we follow our plan, we'll get to around zero around 2040. But with those investment returns, you could see significant variation, both with higher UALs or greater surpluses. Again, this assumes no changes to our policies through that period. So I don't want anyone to think that we would actually generate a $7 billion surplus, because we would probably change things if we have those good returns. On the right-hand side, we added this chart a few years ago because we have spent so long with San Jose talking about recovery and getting things back up. And I wanted to show that, yes, we are making progress, and there is a possibility of getting above significant thresholds, including 80% funded, which is shown by the blue bar, the probability of getting to 80%, and the probability of getting to 100% by the green bar. So we don't really see a probability for 100% in the next year, but then it starts growing after that. It's still very low and off in the future, but the 80% is starting to come within range. So that's all we have for the final valuation. Take any questions. We do have the full report was attached to the agenda, and I have it here and can answer any questions on it if you found the time to dig through that report.
Great, thank you so much. Critical information. Any questions from trustees or observations? Trustee Chi.
So I think you were mentioning that fully funded pensions, generally, they're more sensitive to the downside risk, right? I guess my question is, once they're fully funded, can't you just take risk off the table so you would not be as sensitive?
Yes, you can. There's a cost to taking risk off the table that we then have to adjust for, but that is in fact what I think would be most likely to happen if you start generating a significant surplus. And we're just starting or suggesting to start having those kinds of conversations with police and fire to prep for that event. It's far enough in the future for this plan that I don't think we need to prep for it yet.
Hopefully, some of the current trustees will live to that day to participate in those discussions. Any other comments or observations?
Yes, I have a question. Going back to page 6, I think you'd mentioned the liability experience was the biggest factor in contributing. Can you provide some detail on what part or the breakdown of the liability experience? I know you mentioned it was salary growth, but was that more for growth in salaries of incumbent employees, or was that more due to vacancies being filled?
Probably a little bit of both, but in general, when we're doing a salary gain loss, we're looking at a continuing active, so someone that was active last year and is still active this year. You're looking at what was their actual salary compared to what we expected it based on the assumptions that we have. So with that, there were significantly large increases, much higher than the assumption. One thing to note is when we set the assumptions, we're looking long-term too. So you are going to have years where there's maybe a big catch-up, some years where it's a little slower. So when we set those assumptions, we're looking long-term. So it's not unusual to see the deviation from it. But in particular, when we're looking at a liability gain and loss, if we're looking at the salary, it's really actives that from one year to the other, 1 year to the next, what we expected to happen. We do have a different bucket that if you have a new hire coming in, we look at them as a new entrant. we're always expecting, because we don't account for that, so we always expect to see a loss from new entrants, but that doesn't account for the biggest portion of that bucket. The big portion, particularly in the last few years, was the salary.
And I would just add, you're not unique in that. We've been through a period where we had high inflation and salaries have been trying to catch up. There was a tight labor market, so we saw significant increases in pay for certain positions and across the board increases in everything, and that's really been across all of the public sector plans. So it's not unusual to your plan. It is kind of an unusual time period that we haven't seen that kind of thing for quite some time.
Okay, thank you. And I have one more question. For the assumptions for this current quarter, does that include the annual management increases that are applied for city employees?
So we have.
Sorry, which assumption
for
are
the
you?
management.
For salary increases?
Well, when we do, if it's a negotiated contract, before we do the valuation, we do reflect those increases if it's a known increase that's going to happen. Does that answer your question?
For the management group.
It's separate, yeah. This is the annual management merit increases that are given annually, and usually in October or November of every year.
So we have separate assumptions for the across the board increases and then the merit/longevity increases. And so but those are all built into the projection of salary increases. But if you look at an individual, they will either be promoted or not, and we'll have kind of an average promotion increase that we apply to everyone.
Okay. All right, thank you.
Any other questions from trustees? Any public comment? It appears we have comment. Commenters will have 2 minutes. Please proceed.
We have a public comment from Brad. Mr. Brad, you have 2 minutes, and then you will.
Thank you, Mr. Chair, and thank you for that presentation by Chiron. This is the reason why the abysmal funded status of the Federated Fund will continue to be a drain on not only the active employees through higher contributions and also to the taxpayers of the city of San Jose through loss in services due to the unfunded liability. So I'm hoping now with the addition of a new trustee, you'll have some fresh new ideas, and I'm hoping that 2026 will be a very good year. Thank you, Mr. Chair.
Thank you. Any other public comment? There's none? Okay. Okay, this item does not, do we have to, action just receive?
Yes. No, this is
to approve? Okay, so we do need action to approve the actuarial valuation. So I'll entertain a motion to accept and approve. They're just two attachments that describe the same information in different formats. One is
You're accepting the valuation.
Yeah.
The presentation was just an overview of the more detailed.
There's the formal prose document and then just the presentation that we reviewed. So they're together, it's the same information, as it were.
So I move that we accept the actuarial valuation presented by Chiron.
Great. Is there a second for that motion?
Second?
So we have a motion from trustee Ibett, a second from trustee Linder. Any further trustee discussion? Any public comment on the motion? No comment. We can vote. All those in favor of accepting the valuation?
Aye.
All opposed? None. Valuation is accepted.
Thank you so much for the information and the report.
Thank you.
Thank you.
Thank you.
Yeah.
15 years, that's all we got to hang out for. So this might be.
I was thinking the same thing. Will any of us be around then?
That's right. It's tougher for some of us than
You may be
others.
the president of the university by then.
I don't think so.
That would be great. This might be an excellent time then to pick up with 26B, which was the acceptance of the PAFR. And I don't know if we can call that up on the presentation screen, page 3 of the PAFR.
Yeah, this is a good time for it.
And all I was suggesting is that now that we have approved the valuation report for 2025, that be incorporated into the chart that exists on page 3, so that the final year of the chart is the 2025 numbers. I will also point out that on page 2, where we're showing the actual cash values of the total net position, that goes through 2025.
It's up on the board.
There we go. Page
3.
Page 2 first, maybe? Back. So page 2, yeah, there we go, financial results right there. Nope, come back. Slightly
Yeah.
down, I want to show the chart. So this chart shows our total net position through 2025. And then if we proceed to page 3, keep going just a bit, there, we show the funded status through 2024. And now that we have approved the actuarial evaluation for 2025, I think it would behoove us to have these two charts be consistent and show 2025 as the final year, and that would show the actuarial value of 2025 being 64%, and that also would need to be reflected in the text to the right of the chart there, the final paragraph. So if we're in agreement, I'll entertain a motion to make those changes to the PAFR before publication.
So moved,
Mo-
Mr. Chair.
Thank you. Motion from trustee Linder. Is there a second?
I second.
We have a second from trustee Nakagawa. Any
This makes sense.
further discussion? Any public comment? There is public comment. Again, 2 minutes for public comment on this item.
We have a public comment from Brad. Mr. Brad, you have 2 minutes and then you will be muted.
Okay, thank
Yeah,
you.
just real quick, I don't want to keep being redundant, but, yeah, again, just to look at the funded status is just really disappointing. And, again, Merry Christmas and Happy New Year. Thank you.
Okay, thank you. Any other public comment? There is none. So we have a motion on the table. We can vote unless there's any further trustee discussion. All in favor of the motion to modify the PAFR? All opposed? PAFR is edited. Okay.
All right, thank you,
Now,
sir.
thank yous. Item 6E, election of board chair. Apparently, there is one nominee.
If you'll allow me just to read from the policy quickly
Yeah,
as a
good
reminder.
idea.
At the December regular meeting of the board, nominees who did not accept or decline their nomination at the December regular meeting of the board shall indicate for the record whether they accept or deny the nomination. I believe you accepted the nominations at the November meeting. Any board member who has accepted their nomination may also submit a written statement at the meeting identifying any factors the nominee wishes to be considered with regard to their nomination. At the December regular meeting of the board will elect one of the board chair nominees and one of the board vice chair nominees to fill the respective roles by open vote. And an affirmative vote of 4 board members is required to select the board chair and board vice chair. In the event that there are more than 2 nominees and none receive 4 votes, then there will be a runoff held between the two nominees receiving the highest votes.
Okay. And is it or is it not possible for someone else to be nominated at this juncture? So the answer is no. Okay.
Not without special procedures.
Okay. Which the board could undertake if they wish to.
If it would be a special agenda item ad, we'd have to revise the policy.
I didn't say it was easy.
No, yeah.
Okay.
Anything's possible.
Anything is possible. Okay, so without further ado, unless there is someone who would like to forward a motion to nominate anyone else or to agendize the nomination of other candidates? Seeing none, I guess we don't need a motion for this. We simply vote.
It's not a motion, it's just an open vote.
Okay, and do we have to allow public comment on this vote?
Yes.
We do. Okay, so before we vote, is there public comment? There is no comment. So I will recuse myself. All those in favor of the designated nominee?
Aye.
Aye.
Okay, no executions. The chair is elected. Yeah. Election of the vice chair. Here we have two nominees. And I'll simply add for informational purposes that as the chair, the vice chair does act in this role when the chair is absent, and I certainly will be absent during the coming year. So whoever is elected to this role will be chairing at least one meeting. And I guess with that, I will open it to if either one of the nominees would wish to make a statement, or if any other trustees wish to make a statement about the nominees.
I'd like to make a statement.
Okay, and
But
public comment will be heard in a moment.
I would encourage trustee Faulkner to seriously undertake this role. I've enjoyed doing it, but I think it's time for some fresh blood. And I believe that the time commitment versus the ROI you get on better understanding how the plan works is more than reasonable. So I'd like to influence him as well as the rest of the trustees to consider my worthy opponent.
Would anyone else like to speak to this issue?
Mr. Chair, as the person who nominated the current vice chair, I agree with his position.
Okay.
As Leonardo DiCaprio says in Catch Me If You Can, with the surgery, I concur. So, no, I appreciate Anurag. I got to spend a bit of time just talking about his experience in the role. I am up for the task. So.
Okay, very good. Well, I also welcome new blood for reasons that were discussed, I think, at the previous meeting. We want to get some new folks in the pipeline for next year. So with that, any other comment? Is there public comment? There was. Public comment, will have 2 minutes.
Public comment from Brad. Mr. Brad, you have 2 minutes, and then you will.
Thank you, Mr. Chair. Yeah, well, probably would have been easier if Trustee Chandra just withdrew his name. I don't understand that. But anyway, and I certainly support new blood as a beneficiary and a taxpayer. In retrospect, in the early part of the year when Vice Chair Chandra decided to stay at a hotel costing $1,000 a night, charging it to the fund, I thought was irresponsible. And now that I know that investment decisions are not even made by the committee, the investment committee, apparently it's made by the chief investment officer. So my curiosity is, why, aside from setting policy and whatever, and guidelines, what does the investment committee do? What does the board do if you have one person making this decision on who the money managers are? And because of the abysmal funded status of the fund, why did that chief investment officer, why were they continuing to get raises all this time? I don't understand that.
Okay,
Anyway, looking forward to a new vice chair, and congratulations, Chair Horowitz, on being retained for the chair for this coming year. Thank you.
Okay.
Merry Christmas, Happy New Year.
Okay, just for the record, the investment staff operates under the control and review of the investment committee and the full board. So we are all participants in the decision-making process. With that noted, I will then go to the vote for the candidates. All those in favor of Trustee Faulkner, please indicate.
Aye.
I'll abstain.
Okay, all those in favor of Trustee Chandra?
Oh,
We have one vote.
That's very kind of you.
Okay, but it appears trustee Faulkner carries the day. Mr. Faulkner, you're now vice chair.
Thank you.
You will get all the benefits and compensation due that position. We move on to committee minutes, committee meetings. Investment Committee, we did have a meeting recently. A quick oral update from the IC chair.
So most of what you heard today was covered. We did a little bit more in-depth on private markets, but the board got a full review today of what we did at the committee.
And another good due diligence discussion with, I think, presented by David.
Yeah, we require the staff to present how they conduct due diligence on managers once a year. They rotated this year and explained the private markets, and it was very informative.
Okay. And so we will also receive and file the minutes.
Yes, please.
Okay. Audit Risk Committee, it appears the last meeting was prior to the prior meeting, so there's probably no update there.
Yeah, so there's no update.
Okay.
We had an excellent update from former trustee Avasti last time.
Excellent. Okay. Now we go to the Governance Committee, oral update there. It looks like you've been busy discussing several items here.
Yeah, we did discuss several items, none of which are coming in front of the board for decision today, but we did discuss travel policy as well as this idea that we would rotate committee assignments. We wanted to have additional discussion around that, and I know that our CEO Flynn has said that, going back to travel policy, that there are some changes that have happened within the city as well as council members, and so there'll probably be some more information that we'll want to consider at our next meeting, which will be on the 15th of January. So before our next meeting. With regard to what we're doing with committee assignments and stuff, we had a conversation with both the police and fire as well as our committee, and there were some ideas presented. One of the proposals was that from Aon is that we have a firm limit on number of years you can be on a committee, but there was a sense that we want to make sure that people have a chance to rotate and that we don't lose leadership. And so we're going to continue to look at that at our next meeting. So, but some interesting discussions about what's going on. And as our CEO just mentioned, there also, we have the strategic planning process and surveys ongoing, and we should have an update probably from them in February. Yeah.
Okay.
So
Great.
that's what we have.
Great. On the issue of committee assignments, and would it be acceptable to solicit input from trustees on their feeling? We have not had any tenure requirements for committee assignments. Most of you have been in your committee assignments for pretty much your full time on the board, but I am curious to know how trustees feel about that. How do they feel about rotation? How do they feel about term limits? And
So what I would say is we're not agendized to have that as a discussion item. We did discuss it at the last meeting. If in your, typically at the January meeting, the chair will present his or her recommendations for the board to consider. Maybe in those, you can have conversations directly with the chair, as long as you're not doing serial conversations. You're still protected. The Brown Act is still intact.
I see.
So even as a comment to the governance committee, they're just an update, we can't.
You can make a comment, it just can't be a discussion.
Okay. Well, let me just then leave it as I solicit your individual input to me on your ideas for A, for committee assignments, and B, for the idea of term limits for committee assignments. So, as I believe our next board meeting, I will be making committee assignments.
Correct.
So
That's right.
It will inform those thoughts. Okay. So then we have nothing but to receive and file the minutes of the governance committee?
Yeah, and that was from the previous meeting.
Previous meeting, okay. Then the Disability Committee, it looks like you have met in December.
Right, and we were meeting again, our next meeting will be under the new schedule, the second instead of the first
Okay.
Tuesday of the month, but we'll be meeting February 10th, 2026.
Okay. And so we'll receive and file. JPC, we did have a meeting, December 12th. We have the JPC chair here.
Sure. So we reviewed 70-plus resumes for our CIO position. We narrowed it to 25 who were discussed somewhat robustly at the JPC, and we have narrowed the field to 7 who will be interviewed on January 8th, 1 day, full day. Quite the marathon for the committee, but we did it before to hire this great CEO, so I think we're up to the challenge. And then from there, the schedule continues. We will probably have another JPC, probably a second round with a narrowed list. I think it's second week of February where we call the 2 boards together to make a final decision. And presumably we'll have somewhere between 2 and 3, though that's not been finalized, candidates for the 2 full boards to review.
Okay. And I would urge everyone to make themselves available for that joint dual board meeting, as it'll be a very important decision for us to make.
Yeah, I just might add, and I think the committee would agree, surprisingly strong resumes. And the reason why I'm surprised is I think reporting to 2 boards, I was concerned would be a negative, but we've made the job enticing, and there are a lot of qualified people who want to throw their hat in the ring.
Yeah, well, some of those boards are easier to deal with than others.
Indeed.
I do have a question.
Sure.
Are the candidates mostly from California? Are they from across the United States? Have they had similar types of pension kind of investment? Are they coming more from outside? I mean, just give, I was just wondering if there's a broad
Sure,
brush.
I'll take a stab, and then the other committee members can chime in. Fairly broad, they're a little bit more concentrated on the West Coast. There were people from the Pacific Northwest that expressed interest, but it was national. There were applicants who had also applied, so our recruiter also helped the city of Dallas place their CIO, and so there were several repeat candidates. So there are clearly people who want to move up in their career and are waiting for these types of positions to open up. And then we tried to emphasize some experience in pension or government and just understanding how these types of systems work. We didn't want to exclude people with more private sector experience, but we definitely had a preference for pension experience.
Yeah, I think that's fair.
That's a good summary. Okay. Any other trustee questions? Any public comment? There is public comment. Again, this will be limited to 2 minutes.
We have a public comment from Brad. Mr. Brad, I have 2 minutes and then you will be muted.
Good morning again. Yes, just wanted to remind the board, I know you're probably rolling your eyes and whatever, but I have to, it bears repeating. It's either the city of Fresno or county of Fresno. They have 5 trustees. They do not have a chief investment officer. One of those funds is over 85% funded. The other one is over 100% funded, from what I understand, was what I was told. So I don't know where you're going with this. And again, if the chief investment officer is the sole person choosing the money managers, then I'm really perplexed as to what the rest of the board does. What do they do? Just rubber stamp what the chief investment officer recommends? So anyway, and then that makes you wonder, why are trustees going to these conferences that involve investment managers when they see investment managers there and when they get marketed to? So they have no business going to those since they don't make the decisions. So thank you for allowing me to give my opinion, and have a great rest of the day, and Happy New Year. Bye.
Okay, thank you. So with that, we will receive and file the minutes of the JPC. Update from the Joint Personnel Ad Hoc Committee. Again, I believe that's Vice Chair
No
Juncker.
update there.
No update there?
It's
Very
basically
good.
the JPC's work now.
Okay.
Right, and so that'll be the last time that appears on this agenda.
Okay.
The ad hoc committee has fulfilled its obligations.
Okay. And we have, under item 8, various education and training options. The Calipers General Assembly is coming up in March. Are there any proposed agenda items? If not, we are in adjournment at 11:52. Thank you.
All right, thank you, sir.
Thank you, Chair Horowitz.
Emergency